financing for development. Many of you, I'm sure you're aware, there is this UN process which is ongoing, and we plan to fit into this process with research. I apologize for the huge rooms. Usually for academic conferences, we use much smaller rooms, but this was the only room available for all the time, so if you want to come closer, as you wish. So I let the first session will be chaired by David Vines from Oxford University, so I let David.
Very first thing, could you tell me how to turn this on?
Well, we could swap.
Oh, even better. Well, let me just add to what Ugo said. Welcome to all of you, and just say how grateful I am that all of these four institutions have in their way provided support for this meeting, the fund and DFID and the Institute and the Centre for Finance and Development within the Institute. And I speak on behalf of Chris Adam with me, and the reason we're here is that this has become a real collective enterprise, this conference. There will be an issue of the Oxford Review of Economic Policy devoted to this subject, with some of the conference papers presented in that issue. And I think the conference itself and the issue of the Oxford Review of Economic Policy is going to make a real difference in taking the discussion of all these issues forward. Now, my other thing to say is that I'm required to be a brutal chairman. It's a long conference. We've got very generous time between now and 4 for just 2 papers and discussion. But my job is to make sure that you speak for only half an hour, and then that we make an enforced discipline on myself is that I've turned out to be the discussant in the session that I'm chairing. And then there'll be some public discussion, and we'll do that all properly in an hour, and then the second paper before 4 o'clock. Over to you, please.
Hi, hello, is that on? Yeah. Hi, hello, I'm Ulrich Volz, and first of all, I'd like to thank the organizers for having us. This is my colleague Florence, and our third co-author, Katrin Behrensmann, also wanted to join us, but she got sick, so it's only 2 of us, but enough to present. And the topic of our paper is basically local currency bond market development in sub-Saharan Africa. And what we will do is we're basically doing an empirical analysis of the patterns of bond market development using some new data. The data situation in sub-Saharan Africa is rather murky, so I think the data we coupled together are quite good, relatively. And so what I will do is I will, after a brief introduction, present some few trends on bond market development in sub-Saharan Africa. Then Florence will present the empirical analysis, and then I'll say a little bit about some lessons from emerging markets in Latin America and Asia. So, for the time being, local currency bond markets play a relatively small role in long-term private financing in sub-Saharan Africa. Markets, as I'll show in a moment, have been developing, but it's still at a fairly early stage in many countries. And these markets are very much dominated by government securities. So roughly 90% of the market is sovereign bond markets, and so only a very small share of corporate bond markets. And but we have seen in other regions, in various emerging economies, that there is a huge potential for developing bond markets, both government bond markets and corporate bond markets. And but there is relatively little analysis, which is mostly due to the data situation, I think, on what's been driving market development in sub-Saharan Africa. And we want to shed a bit of light on that. And so this conference is about financing for development, and the topic of bond market development and local currency bond market development in particular, I think is one important part of this long-term financing for sustainable development, for regional infrastructure, or for local or also regional infrastructure development. Local bond markets can play an important role. And we've seen some steps in this direction. For example, Kenya, for a couple of years, has been using infrastructure bonds to invest in its development of critical infrastructure. I think probably all of you are more or less familiar with kind of the kind of basic arguments for development of long-term of local currency bond markets, improving capital allocation and so on. So I don't really want to go that in the interest of time. But what we're doing basically in the paper is, as I said, we want to look at the major determinants of bond market development, but also the factors that are holding back development of local currency bond markets. And we found some nice data where we can make sense of, I think. So let's look at a couple of developments over the past decade or so. There are some positive developments indeed. First of all, the sources of development financing in sub-Saharan Africa have been diversifying. It's been a slow process, but there has been quite a lot going on. And if we look at government financing, there has been an increasing shift away from bank lending to financing through debt markets. Here's a chart showing central government marketable debt as percentage of total central government debt for sub-Saharan Africa as a whole. And we can see that more than 80%, well, it's not now, it's 2012, but more than 80% in 2012 was financed through securities markets. If we look at breakdown of countries according to country income classification, we can see that this is not only due to developments in upper middle income countries like South Africa or Mauritius, but also in low income countries we've seen a greater importance of bond markets in government financing. Also, if we look at local currency financing, there has been a clear trend. The greatest share of government marketable debt is now issued in local currency. So kind of the problem of original sin that Ugo and Ricardo Hausmann and Barry Eichengreen have been writing about has been addressed, and that's indeed one of the important, one of the big benefits also of local currency bond market development. But if we look at the depths of financial market, taking local currency treasury bonds outstanding as share of GDP as a proxy, we can see that markets are still fairly shallow. So there is still big potential, and one of the problems of still relatively small government bond markets in the region is that they also hold back the development of corporate bond markets because of the kind of benchmarking role of sovereign debts. There are many other problems we're still seeing in local currency bond markets or bond markets in general in sub-Saharan Africa. Many of these markets, or most of these markets, are fairly illiquid, dominated by short maturities, and related to that, there are also underdeveloped secondary markets. Still a lot of challenges to overcome, and against this backdrop, we're looking at the factors that are driving or holding back local currency bond market development, and Florence will be taking over.
Okay. As Uli said, there has been a positive development over the past decade, but much remains to do, and there are major gaps also in the area of local currency bond market development. So the question that arises is what can be done, and what are the factors that are actually impeding that development, or the factors that can promote local currency bond market development? Thus far, there has been very little empirical scholarship on the drivers of local currency bond market development in sub-Saharan Africa. One major reason for this is that simply the poor quality and availability of data in the field. In recent years, the situation with respect to data has improved. So, for instance, the OECD has published a large data set on local currency bond market development, covering a substantial number of African countries over a larger number of years, but gaps remain. So, for instance, a recent study by Essers and colleagues from the University of Antwerp used the OECD data set, and their data set or their sample remains limited also to 15 countries in 10 years, that is between 2003 and 2012. So data quality remains an issue. In our study, we rely on data from the African Development Bank's African Financial Market Initiative, which has a comparatively large coverage of countries and years. And our idea is to look at medium and long-term bonds, because we think that these types of bonds, longer-term bonds, are particularly important for financing the SDG agenda. And this is also where our study stands a little bit apart from the few studies that already exist on bond market development or local currency bond market development, because we exclude short-term securities from our study. So our main dependent variable is local currency marketable central government bonds outstanding of a maturity of 1 year or greater, with the GDP data coming from the World Development Indicators. While our data set is slightly different and slightly larger than those of existing studies, the sample size remains limited. So our data set comprises a maximum of 27 countries and ranges over a maximum of 13 years, that is between 2000 and 2013. And this, of course, has implications for the power of statistical tests, and also for tests for model specification. And that is why we employ a wide variety of models in our analysis to test the robustness of our results. So the model that we estimate follows the models in other studies on the determinants or factors which influence local currency bond market development. So our dependent variable is the outstanding amount of local currency treasury bonds as a percentage of GDP. This is a function of a vector of 1 year lagged explanatory variables, country-specific effects, and an error term. And while with the models that we use, we are not able to establish causal relationships, we try at a minimum to ensure that changes in the explanatory variable precede changes in the dependent variable. We also estimate 4 different baseline models, and these are fairly standard in the literature. on local currency bond market development. So the first model is a pooled ordinary least squares models with panel-corrected standard errors. The second one is a feasible generalized least squares model with heteroscedastic error structures and panel-specific autocorrelation. The third model is generalized least squares model with random effects. And the fourth model is an AR1 error model that is a model with panel-corrected standard errors to address panel heteroscedasticity with country-fixed effects and a Price-Winston transformation to address serial correlations of the errors. In selecting the explanatory variables, we also basically followed other studies with a focus both on African countries and with a focus on other regions, because our aim was to look whether the patterns of local currency bond market developments are similar to the patterns that we discover in other regions. And we have broadly 3 different types of explanatory variables. So the first type of explanatory variables relates to economic structure. The second one to macroeconomic policy, and the third one to institutional quality. So I go very quickly through this, and I will say more about those variables later, which turned out to be significant in the analysis. So we included the size of an economy, measured both by the economic size, the size of GDP, and the country surface. We included the stage of economic development, measured by the GDP per capita. We included trade openness. We included the size of the banking sector, measured by private credit by banks, and we included resource dependence. That's a variable which has not been included in many other studies. And we included it because we thought it might play an important role in the context of African countries, because many of these countries are abundant in natural resources, and there is some evidence also provided by a study by Thorsten Beck that there is something like a resource cost in financial development. So it might be that access to resource revenues, to windfall gains from resource revenues, might reduce incentives to develop bond markets or financial sectors more generally. The second set of explanatory variables are the macroeconomic policy variables. So that's the fiscal balance, the fiscal deficits, which is measured as a 3-year moving average of past budget balances, inflation rates, capital account openness, and exchange rate volatility. And the third set of explanatory variables relates to the quality of institutions. So we have legal origin, we have a composite indicator of economic governance, which comprises 2 indicators from the worldwide governance indicators, that is regulatory quality, which captures the degree to which regulations in a country promote private sector development, and a second variable which captures the rule of law. And our third institutional variable relates to the openness of political institutions, that is the regime type, ranging from strongly autocratic to strongly democratic. There are caveats to our analysis. So the major caveat probably relates to the still limited number of observations due to a lot of missing values. The second caveat relates to reverse causality and endogeneity issues. However, we think that our analysis does provide a value added in that it is a novel data set, a relatively large, comparatively large data set with a focus on sub-Saharan Africa. And it enables us to probe the robustness of the results of existing studies by using data which is based on a slightly different set of countries. And it also allows a comparison with results from studies relating to other regions that examined the determinants of local currency bond market development. We try to address endogeneity concerns by employing also GMM, generalized method of moment estimators. However, the drawback is that such estimators are designed for situations with a large number of cross-sectional units and small t, and this is certainly not the case in a data set which comprises 27 countries and ranges and has observations for between 130 and 250. So we employed a wide range of statistical tests, and what you can see here in the slide is just to give you an impression of the most representative results. And these are also the results relating to the most fully specified models from the baseline models. I don't present the GMM results here, partly because many of them turned out to be insignificant, and partly because there are serious technical problems in the estimation of GMM models with a data set like this, where we have a small and relatively large t. So there are four headline results, what you can see here. The first one is that there's a positive relationship between the size of the economy and the depth of local currency bond markets. And this is a finding which is quite common, or which has been found in studies focusing on other regions, such as the study by Eichengreen on local currency bond market development in Asia. The possible reasons for such a positive relationship between the size of the economy and local currency bond market development may be that when there's a huge amount of buyers and sellers in the market, this might reduce price volatilities, which in turn has a positive effect on local currency bond market development. It might also be that larger economies may be able to realize economies of scale in the development of local currency bond markets. And it might also be that there are more diversification benefits for other investors. The second major result is that there is a negative relationship between the fiscal balance and local currency bond market developments. Thus, countries with higher fiscal deficits have deeper local currency bond markets, and this finding as well has been established in literature focusing on other world regions. The third finding is a bit surprising. It's that there's a negative relationship between the stage of economic development and the depth of local currency bond markets. So as you can see, there's a negative sign on the lag GDP per capita. And this is a finding which has also been established in other studies. For instance, the recent study by Essers on the determinants of local currency bond market development in Africa, and also the study by Eichengreen on local currency bond markets in Asia. And one possible explanation we advance, but maybe you have better or other ideas, is that this might have to do with the fact that in poor countries, tax systems are less developed, and this might provide incentives for local currency bond market development. And finally, we also found that deeper banking systems and greater openness to trade has a positive relationship with local currency bond market development, a finding that has also been established already in the literature, which focuses on other regions. What is notable is that resource dependence doesn't seem to have an independent effect on local currency bond market development, but that it seems to mediate the effects of other variables. So, for instance, the governance variables often tend to lose significance once we control for resource dependence. Okay.
David, how much do we have left?
5.
Okay, good. Okay, that's good. Well, so there have been concerted efforts in many emerging economies since the series of emerging market crises of the 90s to develop local currency bond markets. As I mentioned before, kind of this problem of original sin has been identified as one major problem, because currency mismatches and maturity mismatches make an economy, financial system very vulnerable. And so economies in Latin America and Asia, East Asia in particular, have been very active promoting local currency bond markets. And they have been quite successful in doing so. And during the storm of the global financial crisis, we could see that developing these markets has contributed to financial stability. The BIS, for example, has published some reports kind of pointing out that they have acted as an important cushion during the crisis. Here is one table which shows its currency denomination bond markets in different regions. I wish I could present more up-to-date data, but I couldn't find. These are BIS data, but I couldn't find them anywhere in their databases. So if you have any special connections, please let me know. But kind of the main point is that basically in all regions concerned, the share of local currency debt has increased significantly. So, there has been a bit of research, not too much, on the factors that have been driving local currency bond market development in these different regions. And I mean, obviously, the experiences differ across countries, but broadly speaking, the findings that we got for sub-Saharan Africa that Florence just presented were very similar to what many of the studies on other regions found. So size variables, for example, trade openness, and so on. But one point that's also important to mention is that what has been certainly driving local currency bond market development was also concerted policy efforts at the national level. And at least in East Asia, there has been also a lot of regional initiatives promoting local currency bond markets. For example, the ASEAN +3 finance ministers have been developing a number of initiatives aimed at improving regulatory frameworks and so on, facilitating cross-border trading and different things. So these all seem to have been fruitful. But nonetheless, also emerging economies suffer still from a number of problems. Some are similar to the ones I mentioned in the sub-Saharan African context in the beginning. And one point I want to emphasize in particular is that in many emerging economies there's still a very high share of foreign bond holdings. And this is not a problem per se, but it can be a problem. Here is a chart showing foreign holdings of local currency government bonds for a number of Asian economies, and we can see that in Indonesia and Malaysia, the share of foreign holding is above 30%, so quite a large share. And these countries have at times, for example, during the global financial crisis, also experienced problems, because when the global financial crisis hit, Western financial institutions were struggling for survival, and many of them kind of liquidating whatever assets they could, including in emerging markets. And so these countries experienced rapid capital outflows, and with with all the associated problems. Another example is Thailand, which, as you can see here, has a relatively modest share of foreign holdings in its bond markets, local currency bond markets, of about 18%. But Thailand has experienced huge capital inflows after the global financial crisis, with quantitative easing in the US, and so foreign holding of Thai bonds, including corporate bonds, and they made the biggest chunk, increased very rapidly from just 66 billion baht in December 2009 to 870 billion baht in April 2013. That was a peak. And then a month later, Ben Bernanke made his famous tapering announcement. And then there was huge capital outflows, and including big outflows out of the capital market. And Thailand appeared a bit vulnerable at the time because of temporary current account deficit, and Thailand was okay, but that just signified or illustrates how tables can turn very quickly. And if we're talking about sub-Saharan Africa, these countries ought to be very careful. A lot of the sub-Saharan African countries have become frontier markets. So the past couple of years, they've seen large capital inflows also into bond markets. And again, this opens possibilities for long-term financing, but it also increases risks of financial contagion of different kinds. And so therefore, I don't want to just promote local currency bond markets in sub-Saharan Africa as a wonderful means of financing long-term sustainable development, but it's also important to point out that sub-Saharan African countries which are developing these markets also need to work on debt management systems, and also they will have to, or they should, develop their toolkit for capital account management. And since the IMF is a co-sponsor, I'm fully endorsing the IMF's position on that. But I think it's really important to point out also in this context. Florence.
So I will conclude first with a backward glance and summarize the main findings, and then with a forward glance and draw some policy implications. So as one of the main messages of the papers is certainly that local currency bond markets in sub-Saharan Africa are deepening, albeit slowly. And what is also important is that the patterns of local currency bond market development in sub-Saharan Africa appear to be quite similar to the patterns that we see in other world regions. What turned out to be the case is that local currency bond markets in sub-Saharan Africa are deeper in countries which are larger in economic terms, which have higher fiscal deficits, which have larger banking systems, and which have more open to trade. The main challenge for deepening local currency bond markets in sub-Saharan Africa thus will be to deepen these financial markets in countries which are very small in economic terms and which have small banking systems and which are not entirely open to trade. So what could be done? I think one solution which came out also in the case studies of Asia was that regional bond market development might be an option and might help to address the small size of the economies and of the banking sectors. So regional economic cooperation might be an important means to deepen local currency bond markets in sub-Saharan Africa. That said, there are, of course, pitfalls to regional financial integration as to international financial integration in general. And so this has to go hand in hand with a very cautious liberalization of capital markets and with the development of tools of capital account management. And as Uli already said, appropriate debt management is going to be key, and as well as the monitoring of domestic debts. So there is plenty of scope for interventions and for technical advice in these three areas: bond market development, capital account management, and debt management. And there are initiatives underway already. So for instance, there are the World Banks and the IMF's debt management facilities. UNCTAD has a debt management and financial systems initiative. And there's, for instance, also the World Bank's GAMLOG initiatives, which focuses on local currency bond market development in emerging markets. But more could be done in that area. But the guiding principles should in any case be that the sequence and the intensity of policies to promote local currency bond markets should be country-specific. That is, they should take into account the stage of local currency bond market in a particular country. They should take into account the role that the local currency bond market should play in that country. And they should also take into account to what extent there are already institutional and macroeconomic prerequisites in a country. Thank you very much.
Let me be the first to say thank you to Ugo and Florence for a very interesting paper. And as you will have seen from their presentation, this is an area in which not enough is known, in which there's not enough work being done, and there are also interesting, demanding questions about data. The paper really has three parts. First, description of developments. Secondly, some econometrics. And thirdly, some analysis of policy implications. And I want to make my remarks in those three parts. First of all, the description about developments in this area. And what the first descriptive part of the paper makes very clear is just how useful these bond markets can be in diversifying sources of funding, helping diversify risks, better intermediation. There's a sentence suggesting promotion of domestic investment, which I think is clearly very important, but also alleviating risks associated with debt, possibly helping manage the risks of potential vulnerability, liability to financial crisis, and crucially, making some progress in alleviating the difficulties connected with original sin. Now, this is becoming increasingly important. This is what those markets might do, and they are increasingly doing it, you might say, even in sub-Saharan Africa, have been doing it elsewhere in East Asia and Latin America, but it's also happening here. And that figure 2 on page 6 showing how much of public debt is now of this kind marketable is a really revealing figure. And here my first substantive comment is, wouldn't it be terrific to know more about private debt too? And I think both of them are already smiling. I suspect that data is the problem. But it's only part of the story. There was an interesting single sentence remark about how public debt, the growth of markets and public debt underpins the ability of private debt markets to work. Well, be good to know a bit more about that underpinning and what can be found out about that in these countries. Thirdly, they point out, and this is a theme throughout all the discussion, that all these developments are very country-specific. Governance, regulatory and institutional frameworks all differ between countries, and that's important. So that descriptive work at the beginning of the paper, if you like, it whets the appetite. Then what follows, second part of the paper and of my comments, is the interesting econometric work. And I think we should be very grateful to Florence and you for producing this data, which looks like it's been pretty hard work and demanding thing to do. I'll say just 3 things about what's been done. No, let me say the other way around. Let me say what we've learned from that, and the list that both of you gave is a useful a useful list. Size matters. Countries with larger fiscal deficits have more of this. Well, you'd expect that, wouldn't you? They issue more debt if you've got more deficits to cover. Large banking systems, that's interesting. There's some stuff there about financial intermediation lurking. You don't explain any of that, but it'd be nice to understand more about why that's a feature. Countries more open to trade, we'd expect that, more trade finance covered in this way. There's also a weak finding which you didn't concentrate much on in your presentation, that open international capital markets do have some positive effect in the development of these domestic bond markets. And there's a few short remarks about how it could go the other way with capital controls, the opposite, making captive markets which might develop, but that seems to be not the most important thing. The opening and the discipline of opening in encouraging these markets seems to be important. And finally, and not surprising, but interesting, you can pick up that there are negative effects of inflation. The worse the nominal anchor aspect of macroeconomic policy, the less able are these markets to develop, and that's what you'd expect, and it's interesting to see it. So, in some sense, not surprising and reassuring that the data tells us what we'd hope to find looking at data. I'll just make 3 comments about the work. First of all, it would be helpful, I think, to, I'm not suggesting a great rework, but something in the nature of an error correction mechanism would be useful. I'm always suspicious of regressions that have yt as a function of xt minus 1 plus error, because this stuff doesn't happen immediately. Yt isn't depending only on xt, but it's not clear that one lag is enough, and I've done enough work on equations of this kind to know that getting the distributed lag feature of the causality can help you explain stuff that's sometimes elusive. Second thing you touched on, reverse causation. I'm not convinced that the methods that you've used really do eliminate, and you're not convinced either, because GDP is growing over time, and these markets are growing in their size over time. And even if it is the fact that this second one causes this first one, it's not clear when they're both trending that you're not picking up a reverse causation, even if you've got the lag in the structure. I don't think the lag is enough to convince you that you've really dealt with that. And thirdly, I wasn't completely sure why there were 4 methods of analysis used. It looks like find a box of tricks and pull out each of the toys and play with each of the toys. I think it's useful to only pick up a new toy when you've figured out exactly what's wrong with the first toy that you tried. And I'm sure there is an argument lurking there, but it's not explained, about why it's helpful to have all of, I'm sure, tease it out, each of them's getting something that the others haven't revealed. Let's get now to the policy implications, and I'll be brief, but they're interesting. And I would encourage you to say more and think more about this. I suspect that you've got time to do that, and it'll be valuable. First of all, it does look as if, and I'm going to say just 4 things about policy implications. It does look as if the opening of these markets has the effect of lowering the vulnerability to original sin problems. You remarked about how countries which had developed these domestic markets were less vulnerable in 2008 than those that hadn't. And that seems very interesting and important, and I believe you could say more about that. Of course, challenges remain, and this is just your list: illiquid debt instruments, short maturities, restricted investor base, underdeveloped secondary markets. And I would add to that list issues about the relationship between public debt and corporate debt, which you haven't explored. My second point, so that says terrific, useful. There are issues that remain, but helping deal with original sin is a big plus. But secondly, doing this exposes you to foreign risk. Ramanujan Rajan, the tapering risk, all that stuff that lots of us are thinking. Elaine Ray, the trashing of the impossible trinity as a reliable idea, all of this important discussion in open economy macroeconomics. Now, here I'd urge a bit more work and thought. We discussed this a bit at lunchtime. You discussed the case of Thailand. After April 2013, the holdings of domestic bonds by foreigners grew, as compared with just 4 years ago in 2009, stupendous amount, from 66 billion Thai baht. To get these numbers in your head, you've roughly got to divide by 35 to get to US dollars. That's how you think in Thai baht. Some number like that. Went from 66 and 4 years later it was 870. Huge inflows. But within a year after the taper talk began, 1/3 of that had gone away. Now, you talk about that as being destabilizing, and the whole of the emerging market policy community uses the word destabilizing to talk about that. As I said at lunchtime, Paul Krugman's Polack lecture the year before last was designed to challenge this view, and Australia and Canada provide advanced country examples of countries for whom very significantly moving exchange rates are not a destabilizing feature, they're a shock absorber. And needs to be more analysis of the circumstances under which that can be the case. And I'd be the first to line up and say that you need a robust nominal anchor, and you also need to be prepared to deal with very significant movements in relative prices between tradables and non-tradables within the economy. And if you can't deal with those two things, then you really should be worried. And in a sense, I think of Ramanujan Rajan and others as representatives, if you like, of countries for whom those two issues are real big issues. So going this direction requires adequate it requires a foundation. You know, Asian miracle, don't do this stuff unwisely. Get a framework in place. And that requires adequate regulatory infrastructure. It also requires reliable fiscal and monetary policies. Proceed cautiously. There's a sequencing issue. Learn from the Asian experience of the 1990s and come to understand that capital controls and macroprudential policies are all elements in the mix of dealing with moving in this direction. So, and that's all talk about what individual countries need to do. And I'll conclude with my last remark, which is there's something I think that the global community needs to do as well, what I think is an important G20 issue, and this is the mobilization of liquidity support for countries of an emerging market kind in which capital markets aren't as developed as Australia or Canada, in which these shocks from abroad, you know, this is my problem that the tapering talk is coming from New York, it's coming from abroad. And we all know that in 2008, there were a privileged few that got access to swaps from the Federal Reserve, and many in policy making, both in Eastern Europe and in Africa and Latin America and Asia, felt denied the insurance and security that such swaps might provide. The alternative is credit lines from the fund, but we all know that the FCL and other fund procedures for for providing this liquidity support have not been successful for political economy reasons. So I think there's not just a domestic set of issues to discuss in relation to this question. There are some global, international financial system issues to discuss in relation to the development of these markets as well. But back to where I started, thank you for putting us onto this. Very, very interesting. Okay, now please, why don't you come up here, and if we can make our microphones work, and if we can't, just step up to to the microphone there.
It's broadcasted.
Oh, very good. And indeed, if you could, Ugo, take this around to people so that, and I should be saying this, well, I'll go and stand there. You go around and show it to people who want to ask a question. First here in the front, number one, and then Chris, number two.
Thank you, David. Thank you, the authors. I have two questions, one comments. The question is, bothers me more further is who's holding those local government bonds, local currency bond. If domestic banking sectors are full of local currency government bond, we might lead to a very dangerous issue, so-called crowding out private investment. Okay. Secondly, the price, the yields. If we have no idea about the cost of borrowing in terms of controls, you can use the borrowing control as a yield, maybe run another regression in terms of yield difference. Then you can see what we know better is what's the cost of capitals. Last thing related to GMM. So there's one very nice way based on, besides the systematic GMM, we can use dynamic GMM to deal with a big N, big N, small t. You can use X bound 2 in this data, so we can deal with the issues. But ideally, I want to see better in terms of variations. And the last thing is you can do, follow the David suggestion, you can use a foreign reserve over GDP as a control to see whether a country have a high reserve ratios, have more risk takings, more issue, more bond or not. Okay.
Now, I think these are particular questions and you should deal with them as they come. And can we get this? This is working. There you are. Who wants to start?
David, can I
please
do a follow-on because it's essentially the same question. So it follows on from the previous one. So my name's Christopher Adam. I'm one of the co-editors of Oxrep. I like the paper a lot. I think there's a lot of stuff in here. I wanted to make a couple of very specific comments. The first is on data and evidence. There are 2 or 3 IMF working papers that the lead author is a guy called Ali Abbas, A-B-B-A-S. And he's worked with Jakob Christensen, developing a domestic debt database for low-income countries. Like you, they put an awful lot of work into this. This is more on the dependent variable side of your empirical work, but it's definitely worth looking at that work by Abbas and Christensen, and later work by Ali Abbas, because one of the things, 2 things that they do in that work. One is trying to get a handle on the ownership side, who's holding this debt. And I think this previous point about if this has all been held by banks, it has a very different impact in terms of debt holding by the non-bank private sector. And secondly, they look quite closely at issues to do with the yield. So again, the same issue about what's the cost of domestic debt. So I think that's worth following up for completeness. I wanted to just make one observation on what you said was a counterintuitive result, and that's when you have this positive effect of GDP, log GDP on bonds to GDP, and then this negative effect of the GDP per capita. I'm just worried that there's you've got a problem with measurement here, not least because the population data underpinning your GDP per capita is an interpolation over kind of 10-year census. So it's an ultra smooth interpolation of population. So if you think of the variation over time, those 2 variables are going to move very closely together. The other way of thinking about that is the coefficient on GDP per capita is it's the partial. It's holding all other things constant, including GDP. So what that coefficient, the second one that's giving you the negative sign, it's actually picking up the positive effect of population on bond markets. So if you wanted to test that, you would just drop your GDP per capita and include population. And I think you'll find that puzzle will disappear. Nice. I have a couple of other things, but short on time, so let me pass it on. I can come back after the event.
We have one more question here, but you let...
Yes.
Actually, it's not a question, it's just a follow-up from previous observation, it has been pointed out that it's very important to know who are the holder of a bond, in particular the banking sector, but I would also suggest to, and I would also want to know whether these data are net of central bank holding, because it's probably going to make a big difference across countries.
Another follow-up, so similar issues on the issue of data. There is this work by Abbas. I advertise my own work, and Alessandro's PhD, former PhD student. She has done a lot of work in collecting data, and we have a data set which is actually an extension of the Christensen's data set, when we have, again, holding, and we have also this issue of the central bank's holdings of debt. Yeah, I think it probably would be very interesting to try to put everything together, because I think your data can complement very well the work that is already out there, and it's really very important to try to find a consistent way to have a data set as larger and consistent as possible across countries. Another issue is, again, in one of these works, Giovanna was trying to look at the drivers of domestic bond markets. And one of the variables that turned out to be importantly a good driver of that, and it's not in your analysis, is debt relief. So basically, if you take into account, probably it's in some of your dummies or time dummies, but it would be nice to see if HIPIC or MDRI are in somewhat correlated to domestic debt accumulation.
I can start and then Oliver take over. Okay, so maybe I start first also with some answers to some questions David raised, because I think the questions related to the data and to the models are kind of interconnected. So the data we used from the African Financial Market Initiatives focuses on local currency government bonds, marketable bonds, right? And we did not include corporate bonds in our analysis because the data on local currency corporate bonds in Africa is very scarce. And so I think that would be actually an area to work on, although, of course, as local currency government bond markets are not very developed at that stage, corporate bond markets are at an even earlier stage or even embryonic stage of local currency bond market development. There might be exceptions, South Africa, for instance, but I think for many countries, they simply do not play a bigger role. And I think one question was related also to the models that we've been using. So I think the main answer why we used several models is because we do not know the true model. It's not clear what the true model is, and so the idea was to use various models as robustness checks and see what kind of variables can we find that are relatively robustly across the various models associated with local currency bond market development. That said, and we implemented also some model specification tests, like, for instance, a Hausmann test and so on, but also these kind of tests are limited by sample size. So in the end, I think as we move on with the paper, we will focus on one particular model, but at the stage where we are now, it was just important to experiment with the different ones and see which variables are relatively robustly associated. With the GMM models, yes, we also experimented with we used the XTR bond command by Ridman, actually. And this offers the option to limit the number of instrument lags, the number of instruments. So, but still, our number of instruments and our number of instrument lags are quite close, and the instrument count is still quite high, even if we limit it to 2 lags. So, and this also calls into question the extent to which this is the right model to explore these issues. Many thanks for referring us to the data set on domestic debt in local low-income countries by Abbas and also by Andrea. So this is something we should talk later about that. Many thanks for that, and also many thanks for the variables that you suggested, the foreign exchange holdings, and also to experiment by taking out the effect of population. So that's a very good hint. Thank you.
Yeah, also thanks a lot to David and everyone else for their comments. I'll just pick a few points to add on. I do agree that it would be wonderful to have, to explore more the role of corporate debt, and also this issue of who's actually holding the debt. Well, we'll have to we'll get in touch with you kind of on the data set we might get or not get, and see what we can do. But at least what we will certainly do is discuss, for example, the also financial stability implications. I mean, if the entire sovereign debt is held by the domestic banking system, this, I mean, we know a couple of countries nearby which have been struggling with that. So these are certainly things we also need to discuss, and we'll see what we can do on the data side in this paper, or maybe some follow-up paper. On the kind of financial stability, international capital flow issue, well, we already spent lunch break over that, but so we don't want to bore you with our discussion on that. But I think it's very important to point out that when Krugman is talking about Canada or Australia, that's something different from when we are talking about sub-Saharan Africa. I mean, I think this point is very clear. And even Thailand, I mean, I use Thailand as an example because I work a lot on East Asia, and I just, got the data quickly, so I use that as an illustration. But I think it already shows that even a fairly well-developed emerging economy with deep financial markets can be hit quite badly. And there are other countries like Indonesia which have been struggling quite badly with the same problem. So this is an issue. So in recent episodes, it went well, or relatively well. But who knows how it will go when the next typhoon will hit these shores. And so in the sub-Saharan African context, I think there's all reason to be cautious. And I'm personally, I'm not really an Africa expert, but from the data I've looked at, I'm rather concerned at the speed of capital inflows we've seen over the past couple of years, and some economies down there look very vulnerable to me. And I mean, so I do hold up this point about being very cautious with capital inflows and so on. And obviously, they can also have very positive impacts, but it also depends on what you use them for. And that's also why debt management, public debt management, is very important, but also why financial regulation is very important, because you don't want to have your corporates to have huge exposure abroad and then kind of lose control. And I fully endorse David's point about G20 or whoever picking up work again on the global financial safety net, which doesn't really exist at the moment. And I think in the next couple of years we'll need these safety nets. Yeah, on the other points, I think Florence has more or less answered, so I'll stop here. Thank you.
Well, could you join me in thanking both of you for a very interesting hour?
I'm going to turn this off.
think I'll just immediately pass over to you. Do take your laptop with you.
Thanks.
Okay, I will try to take this presentation away and put mine. Let's see if I can do it. There must be some plug somewhere. No, I have it. This,
The plug is here.
This one is still on.
No, I think looking for the screen, not the microphone.
okay. Okay, it should show up in a moment.
Right.
Okay, so first of all, I want to thank the organizer for giving me the opportunity to present this joint work with Emanuele Bacchiocchi of the University of Milano. This paper is about loans. So the first paper that was just presented before, this one was about markets. This one instead is about non-marketable index debt. And in particular, we are going to study the potential for a reform of multilateral lending based on debt indexation. So which kind of index debt are we considering in this paper? We want to examine the cost and benefit of debt, which payments are indexed to macro variables that are related to the borrower's ability to pay. The outline of the presentation is here. I mean, we first look briefly at the benefit of index debt. Then I will say some words about the type of indexation we are considering in the paper. Then I will present a simple model of debt sustainability. I will mostly focus on the intuition rather than the math. And then I will show you the result from empirical estimation. We are trying to estimate the optimal share of 3 different types of index debt. Because one of the aims of the paper is to compare different indexation method, because there has been argument in the literature in favor of one type or the other of index debt, and then what we do in this paper is to compare the benefit and cost of these 3 types of indexation. Then we will look at the cost of providing this insurance, because of course the borrowers may benefit from indexation, but the multilateral lenders may be exposed to higher risk, and therefore we see whether by portfolio diversification this lending program, this index lending is feasible or not. Okay, and then I will talk about. I will briefly review the arguments against indexation and talk about practical issues for implementation. So, as I told you, the motivations of this paper is to examine the benefit and cost of multilateral index loan. What we want to do, we want to see whether a reform of multilateral lending is justified and feasible, is economically justified and feasible. The aim of this reform will be to reduce the risk of debt crisis by making the debt contingent on the future performance of the country, and at the same time, this will allow to make loans to all countries. So one of the aims of this reform would be to make countries that are considered at risk of debt distress able to receive loans. well, I mean, unfortunately, everything is messed up, but I hope you can still see most of what is written in the. Is it okay? Okay, because I also have a PDF if you. So there are many types of index debt. So we focus on three main types of indexation. The first one is foreign currency loan indexed to real GDP, and GDP growth is measured in local currency unit. And we compare this with foreign currency loans indexed to the dollar value of export. And we also consider local currency loans indexed to inflation. I mean, there has been argument in favor of one or the other. The problem is that there has been so far any comparative analysis of these three methods. You can find there some of the economists that work in this field. So let me briefly remind you what are the benefits of indexation. So if you index if we link payment to some variable that are related to the borrower ability to pay, then we will be able to provide insurance against macroeconomic shock. And this index debt will also help to stabilize the debt to GDP ratio. We will see why this is beneficial to this country. And of course, there is also a benefit for the entire community, which is to avoid repayment difficulties and reduce the probability of debt crisis and default. And this benefit is both for low-income countries and for multilateral lenders. So one way to think about, so we're not only considering the pros and cons of indexation, but we also, what we have in mind is to see whether this program of multilateral index lending can implement a risk sharing scheme between low-income countries, in the sense that if risk is not systematic, then countries that are performing better than the other will pay more on their index loans, and this will allow to ensure the countries that are performing not as well. And therefore, through multilateral lending, we can actually implement this kind of risk sharing between low-income countries. Another benefit of this risk sharing mechanism is the fact that you do not need to decide in advance which country deserve to receive loan and which countries instead only receive smaller grants, which is the system which has been used since 2005 with the reform of the debt sustainability framework. Okay, so the type of indexation that there are two types of indexation that are available. One is interest indexation, and the other is capital indexation. So we will look at capital indexation. Interest indexation make interest payment depending on the difference between the realized and expected growth of a reference variable. It could be GDP growth, it could be export growth in our case, or the real exchange rate. Instead, capital indexation links the principal of the loan to the level of the reference variable. So in this way, all the interest payment and amortization payment are adjusted to the cumulative growth differential between, let's say, actual realized GDP and the cumulative growth of the baseline GDP. So one way to, I mean, we think that this is this is a better system for multilateral loans because it really is the system that provides insurance. And the reason is the following: with interest payment indexation, you actually cannot, interest payment indexation has a limit which is given by the fact that interest payment cannot be negative, and therefore this system does not provide any insurance when insurance is most needed, when output falls or when export falls. Instead, full indexation, which is provided by capital indexation, is, in our view, a better system. If you look at the last equation, you see basically that you link the value of the loans, the principal, D0, to the ratio between the actual realization of the reference variable and a baseline trend, which we may think as the expected level of this variable, which has to be set at the time the loan contract is made, which in this case is the time 0. One way to think is that about this kind of indexation is that the country pays more when when output outperform expected output. So when your performance is better than expected, then you should pay more, and you are going to pay less when your output falls below the level which was expected at the time the contract was made. We have a model of debt sustainability in the paper, which is a bit complicated, but the intuition is quite simple. So the low-income country and the multilateral lender want to minimize the probability that the debt ratio exceed a certain threshold, which is here is BT. So this kind of objective clearly implies that if the expected borrowing cost isn't changed, then you should prefer a debt strategy that minimizes risk. So you should reduce the uncertainty of the debt ratio. The idea is that debt stabilization, so stabilizing the debt ratio around the expected value is optimal. And you may think of more risky debt instrument. What they do, they just imply a mean preserving spread of the probability density of a debt ratio, which of course increases the probability of exceeding the threshold. Or if you want to say the same thing more loosely speaking, you can think of the fact that a bad shock increases the probability of exceeding the threshold, while a good shock doesn't affect it. So the best way is to avoid shocks. So what you should do is to make your debt position resilient to any shock affecting the debt ratio. Of course, the model is more complicated because we have to trade off stabilization, so risk reduction, against the cost of insurance. If the expected return of indexed debt is higher than conventional loans, then of course there is also an effect on the expected debt ratio that we have to take into account. What are the model implications? The model implications are quite simple. Debt instruments should insure against shock to output, net export, and the real exchange rate, which are the shocks that affect the debt to GDP ratio. And of course, the hedging property of a debt instrument depends not only on the volatility of the reference variable, but also on the conditional covariances of the return of indexed debt with output, net export, and the real exchange rate, which is something which is I never found that was considered in the literature, because usually what in the literature is done, we say, the kind of empirical analysis which is done is by counterfactual. What would have happened if a country have issued debt indexed to GDP without taking into account the fact that there are other shocks that may affect the debt ratio. So the main point of our of this model and of our empirical analysis is that the optimal type of indexation or denomination does not only depend on the relative volatility of the reference variables, but it also depends on their correlation with the other variables affecting the debt ratio. And this is clearly shown in this equation. This is the equation for the optimal share of debt indexed to GDP. And here, it looks complicated, but actually, let's suppose that the risk premium is 0. So let's suppose, this compare GDP indexed loans against conventional loans. So let's suppose that there is no risk premium that the borrower has to pay by indexing the debt to GDP. Such that the expected return on a conventional loans and the expected return on indexed loans are the same. So the difference between the two interest rates, R gamma and R, which represent the interest rates on indexed debt and on conventional debt, then it is 0. So the first term in this equation becomes 1. Which is to say that, of course, debt indexed to GDP provides full insurance against shocks to GDP. But then you also have to consider the covariance of GDP growth with exchange rate depreciation and with net exports. So the idea is that GDP index debt is even better if there is a negative correlation between real exchange depreciation and GDP growth. Why? Because in that case, you will pay less when you have a real depreciation. Instead, a positive covariance between net export and GDP growth will also increase the optimal share of indexed debt, and the reason is that when you're you would like to pay less. This type of indexation allows you to pay less when you have a poor export performance. So this is the intuition. Of course, if instead the multilateral lenders would ask for a positive premium on indexed debt, then you would also have to consider the additional cost of indexed debt. And therefore, you have the last term, for instance, which capture the effect of the risk premium. If indexed debt has a higher expected return than conventional debt, this, of course, reduces the optimal share of GDP indexed debt. And you also, I don't think I have time to go through in detail with all the other two optimal shares, but here you can see that for the case of debt indexed to the value of export, of course, the optimal share of this type of indexed debt is going to depend on the correlation between the value of export, which determine the return on this debt, and output growth. If the correlation is positive, then higher share of index debt of export index debt should be issued. And the reason is that, of course, in good times you can afford to pay more on this debt. Instead, if and during bad times when your output falls, then it would be better to pay less, and this can be done. I mean, this is feasible if there is a positive correlation between export and GDP growth. And again, you can also look at the other correlation or coefficient. And we also have a similar optimal share for. We can derive similarly an optimal share for local currency inflation indexed debt. So in the end, what we do, in our empirical analysis, we try to estimate these shares, and basically we have to make the assumption, the maintained assumption that the risk premium is equal to 0. Then we will study whether this is whether it is feasible for multilateral lenders to make loans at the same expected return of conventional loans. But when the risk premium is equal to 0, so the empirical strategy to derive this optimal share is to estimate the conditional variances and covariances that are shown in these equations. So, how do we estimate these variances and covariances? We do it through vector autoregression models of each country. We use to compute these conditional covariances the 5-year and 10-year ahead forecast errors obtained from this vector autoregression. And this vector autoregression estimates of simple models which relates GDP, the value of export, the real exchange rate, and then net export. So what is the motivation for using forecast error? First of all, the forecast error captures both the deviation from the conditional mean and the error made in the forecast, which is what would happen if what would usually happen if in the contract, in the loan contract, the baseline level of GDP, say, or export would not be equal to the expected. Okay, I take it back. So the idea is the following: the baseline level of GDP or the value of export that is written in the loan contract, in our view, should depend on the expected level of GDP, on the expected level of the value of export and inflation. However, what happens usually is that this may not be the case, and therefore we want to consider not only errors that are due to variation around the conditional mean, which is what we usually do when we do impulse response function, for instance, but we also want to see what happens if we make prediction mistakes. So if we forecast the expected value of GDP or net export or export not correctly. Okay, so we ran a VAR model for each of our 40 EDA countries for which we have data. The period is the 1990-2010. The variables are real GDP, the dollar value of export, real exchange rate, net export, the real GDP of OECD countries, and then also a set of exogenous variables. And here is the, I summarize in this slide our finding. Out of 40 countries, this is these are just for the 10-year ahead forecast error. The evidence for the 5-year ahead forecast error is the same. So what we find is that 29 countries out of 40 will benefit from some or some GDP index debt or the entire debt index to GDP. This number of countries increases when we consider export index debt. As you can see, only 6 countries out of 40 would be better off with conventional debt. 34 countries would be better off with at least some export index debt. And finally, for local currency inflation index debt, we have that the majority of countries will benefit from this kind of debt and this kind of indexation. And then in the bottom part of this table, we have a number of countries which, I mean, we have the number of countries which falls in each of these optimal shares. So you may notice that in the case of GDP indexation, 28 countries would have an optimal share which is at least equal to 1, which is to say all the debt should be indexed to GDP. For export indexation, only 14 countries. In only 14 countries, the optimal share of export index debt would be equal or greater than 1, and 21 countries would have a share of this local currency inflation index debt at least equal to 1. So what we conclude from this evidence is that for the majority of countries, the optimal share of GDP index and inflation index local currency loans are greater than 1. And the reason why we have this result is that we find a negative covariance between GDP growth and real depreciation, which can be explained. I have 2 minutes, but maybe if you give me 5 would be fair. Okay. So what can I say? I mean, it's difficult from this. It's difficult. To decide which is the best type of indexation from this evidence, because GDP index debt would help to stabilize the debt ratio in 3/4 of the countries, but a larger number would benefit from loans denominated in local currency. There are also 2 countries which are better off with conventional loans, which is to say that this is a typical case of that there is no one-size-fits-all solution. Then what we do, we don't have much time, but what we do, we look at the feasibility. We want to see whether through portfolio diversification we can limit the risk exposure of multilateral lenders. And what we find, I mean, I don't have much time, but these are standard deviation from returns out of GDP index debt. The black line is for individual country loans. The average of the average of a country is given by the dashed red line, and the blue continuous line instead is portfolio risk, which is very, very low. Only 5 countries have a lower risk. And the same kind of evidence can be found for export indexed loans and for local currency loans. So there is a huge there is a huge scope for portfolio diversification, which suggests that this, yes, 1 minute, which suggests that this type of loans, this index loan, could be issued at the same expected return as conventional loan, because this the higher risk of individual country loans can be diversified away in the portfolio of multilateral lenders. What we also find, we estimate a capital asset pricing model to estimate risk premium. And what we find for GDP indexed loans is that the average risk premium is below 1%. And this is also true for portfolio of loans of this type of debt. The same kind of, for local currency inflation index loan, the risk premium is even negative. And instead, what we find is that for export indexed loans, the risk premium is very high. So export indexation is not feasible, while the other type of indexation can be implemented by multilateral lenders. I don't have time to discuss what are the arguments against this kind of multilateral indexation program, but there are also practical issues that probably the discussion will take up, and we will have more time later to see why it's difficult to design this type of loans. Okay, thanks a lot, and sorry for it. Okay.
Okay, so I'll be discussing this paper by Alessandro and Emanuele, and I guess I'll be more Catholic than the Pope, because I like their proposal more than they like it. So when so Alessandro didn't have time to discuss possible problems with his proposals, and I will argue that many of the problems, it's very honest in the paper pointing out problems. I would actually argue that these are not big issues and could be solved. So I would like to divide my remarks in 4 parts, provide some background, and then say why I think the paper is really important. And then, so Alessandro didn't have time to talk about argument against it, but I guess I summarize it, and I say that some of these can actually be used as arguments for, and then some small quibbles, but these are really small things. So background, so Alessandro mentioned this, so I think this fits well in the loans versus grant debate. So you have these donor agencies like IDA, the World Bank, but many others, which give money to low-income countries, and basically they have to decide whether to give this money as concessional loans. So when Alessandro talks about loans, he talks about loans in which about 60% of the loan element is concessional. So if I give you 100, you're going to pay me back 40, and 60 is a gift. Or whether to just give a plain grant, so I just give you the money. So there's been a huge debate on this grant versus loan debate, on whether donor agencies should give grant or loan. So for instance, the former Treasury Secretary of George Bush said, the World Bank has driven countries in a ditch by giving them loans instead of grants. Many NGOs think that grants are better than loans because you don't have to pay them back. But so this is sort of straightforward. But if you think that a country or a donor agency has a given aid budget, if I have a budget of 40, I could give you a grant of 40 or give you a loan of 100 with a concessional element of 40. So at the end, it's true that the grant you don't pay it back, but with a loan you get more money. So there are trade-offs. So how do we navigate this trade-off? Well, in theory, and there is a nice theoretical paper by Cordell and Dulco that show this. In theory, you should see if countries are able to absorb money and if they have capacity to repay. So if countries are able to absorb money and have capacity to repay, you should give them a concessional loans. Instead, if they are able to absorb less debt and they have limited capacity to repay, you give them a grant. Well, that's fair enough. Now, the problem is that if you think about this type of loans, these are loans that I give you now. So these are think about the typical IDA loan. So I give you the money now. You don't give me anything for 10 years. There is a 10-year grace period. After 10 years, you start repaying me back, and you pay me back after totally about 30 years. So I need to make a decision now about whether to give you a grant or a loan for something that which you will start repaying in 10 years, and then you'll repay over a period of other 20 years. So the point is like, so how do I decide now whether you'll be able to repay in the next 30 years, starting 10 years from now? Well, because that's what I need to know, whether I give you a grant or a loan. So here enters, so I need some sort of crystal balls to look at what's going to happen in the next 30 years. And here the fund and the World Bank have developed a very sophisticated system to evaluate capacity to pay in the very long run. This is called the Debt Sustainability Framework. So what they do, we forecast GDP growth and therefore ability to pay in the next 20 years. You look at quality of policies institution, and then based on all this mumbo-jumbo, you decide whether you'll be able to repay. And then once I have this, I decide whether I'm going to give you a grant or a loan. So the problem here, the noise-to-signal ratio is huge. So being able to guess now whether a country will be able to repay in 20 years, it's not easy. So I like this sentence. So this is a sentence from the current chief economist of the fund. He was not the chief economist of the fund when he said this. And he was talking about fiscal indicators, long-term fiscal indicator for OECD countries, not for low-income. So here we're talking about low-income countries. He was talking about OECD countries which have much more stable and predictable economy than low-income countries, and trying to discuss this stuff. We have all this sort of predictor of debt sustainability, of fiscal sustainability, but they're sort of useless because there is no way we can make long-term forecasts. So this is what the chief of the economist of the fund was saying a while ago. Now, so for instance, if you take a standard model and you try to evaluate the forecast, and you're trying to forecast growth after 10 years, and then you evaluate the average forecast error, and you do this for advanced economies, for OECD countries, you get that the forecast error is about, depending on what you look, well, let's say about 12%. So if I try to predict growth, where the GDP of a country, of a OECD country, will be in 10 years, I'm going to make, on average, a mistake of 12%. I could overpredict or underpredict on average 12%. If you try to do this in a low-income country, you're going to get a median forecast error, which is 3 times as large. So now, if you believe what Blanchard was telling us, that we cannot do this long-term forecast for advanced economies, guess what can do for low-income countries? But then we built our debt sustainability framework on this thing, on this forecast, which are noisy. But that's the system that we have now. So why do I think that this paper is important? Well, it's important because we use this system to allocate a lot of money. So this is just IDA. So IDA in 2013 allocated with this system about $16 billion. But this system is not only used by IDA, it's used by the concessional arm of the Inter-American Development Bank, and it's used by donors in very many countries which sort of follow an approach which is similar to this one. So maybe you could double this amount of money. So this system is used to decide maybe to allocate about 30 billion per year, which is, some money. And it's based on something which is the best thing that we have, but it's noisy. Now, if you say, if you go to anybody, say this is a problem, they tell you, okay, it's a problem, but we have some sort of model which is not perfect, so you need a model to beat a model. And so an alternative model is like, since these guys are not going to pay for the next 10 years, why don't you decide on the grant versus loan in 10 years instead of deciding now? This is the same thing as saying, just index the debt to something, to capacity to pay, when you will start to pay. And so this is equivalent to the X in the load. You need a model to beat a model, so the current system is the DSF, and what I think Alessandro and Emanuele are giving us is they are the first building blocks for an alternative model to allocate all this huge amount of money. So that's why I think the paper is very important. So the DSF will still remain useful for other purposes, but we can think to allocate grants versus loans using a different story. So in the paper, Alessandro lists a bunch of arguments why this thing might not work or it might be complicated. I think that most arguments are, there are problems, but there are always problems, right? So are these problems or not? So the first person that people might scream at this thing is moral hazard. Now, if I make you repay on the basis of how much you will grow, you will have incentive not to grow. Now, it seems strange to me. So, so if I ask a policymaker, would you rather be South Korea and repay some debt, or be a very poor country and not have to repay debt? If the guy decides to be the very poor country and not to repay the debt, probably this guy should not have gotten concessional money to start with. So I don't think that the growth argument, there is always moral hazard, but I don't think it's first order. So I don't think that growth indexation generates huge moral hazard issues. Of course, we can build a model which there is moral hazard and everything, but it may be more of a problem if we index to local currency, index to inflation, because here there is more space for opportunistic devaluation, which is Alessandro and Emanuele point in the paper. The second problem that Alessandro points out is the fact that the data are bad. That's true, but the data are bad now too, and whenever we do the DSF, we're using bad data, which are probably even worse than the data that we will have in 10 years, so it's okay. Plus, if there are real money attached to this data, so maybe there is a silver lining. If there is a real money attached to this data, maybe there will be incentive to improve data collection in this country, so maybe the system has a silver lining. Complexity. So here there is a big discussion that Alessandro didn't have time to go over it. But if you index the debt to growth, for instance, you need to have some sort of baseline growth. So if you think that a country is expected to grow at 10%, then you use this as a baseline, and if it grows above 10%, you'll make it pay more, and if it grows below 10%, you'll have to make it less. But then every country will have an incentive to say, well, I'm going to grow at 40%, because then they always undershoot the target and they always pay less. And this is indeed an issue, but I think that, given that this is still concessional money afterwards, I think that the system would work with some average baseline growth, which is the same for every country. And then countries which do well will pay a little bit more, and countries which don't do so well will pay a little bit less. Of course, this is optimal if growth outcomes are purely driven by shocks. It's less optimal if policies matter, but one could devise a system to think about these issues. But again, this is fully coherent with the cooperative nature of multilateral development banks. After all, if you borrow from the World Bank, you pay the same interest rate whether you're a high-risk country or a low-risk country, which is again has to do with the cooperative nature of these institutions. Some small quibbles. One big issue, we go back about the data, so these shares are estimating using a VAR, using data for this country, which number one are bad, and second, even if they were good, these countries have huge structural breaks, so how much do we need VR based on this country with very highly volatile economy? This is always a problem, so maybe we could think about alternative methodology to check the robustness of the approach. And one last thing, so if you read the paper, what Emanuele and Alessandro show, they show that GDP index debt is better than export index debt, which is better than, which is better than non-index debt, but local currency debt is even better. So I like the idea of local currency debt. So I was part of this original sin movement and all this stuff. But as they also discussed, moral hazard is more of an issue for local currency debt and growth index debt. So if we were to make the paper robust to the Lucas critique, that is, if we think that if we change the rules, the behavior will change, and if we were to incorporate this in the model, then maybe the conclusion would change. So we need to think more about this. But so this is a very nice and important paper. I really like it. And that's it. Thank you.
Well, why don't you both come up here and let's ask for questions, comments.
I can bring the microphone.
Chris, why don't you take over the microphone, and Ugo, you can come and be up front.
I can speak live.
Yeah, please.
I come from Myanmar. I live here 32 years in Switzerland. I'm going back to Myanmar in 1st of August to do the business there in the government part and private part, and I will be doing the consultant in there. You are welcome to come to Burma, to the bank. It's open. We have an election in November 2015, a new president, a new evolution, and maybe Mrs. Aung San Suu Kyi will be Prime Minister, will be a president. I don't know. Who knows? This is a question is, how to say, we are going to development in my country, and we have to do a lot of things there. And now we have a lot of building, hotels, and everything is there. And by one question is, another one is how you will come inside, and if we have built a lot of building there, hotels and everything's in the Burma. And I would like to know, do you accept the private center is coming to in Switzerland or coming to there in Myanmar in interest? I don't know, this is my question, if you can help it. Or the Burma is really GDP is different way from Thailand.
This is a question about who bears the risk of this.
Sorry?
This is a question about who bears the risk of these developments.
Yeah.
Next question. Please.
Sorry. Okay, we'll start.
You first and then you. Oh, thank you. Thank you.
Thank you. Thank you to the presenters for their models. Just playing devil's advocate, there's a new bank being established, the AIIB. How will the models projected by this bank be different or similar to the models already in the existing system? Thank you. In terms of infrastructure development.
Hi, I'm Liam Wren-Lewis from Paris School of Economics. I just had a question about when you're doing the comparison of portfolio risk, what are you assuming about the difference in default rates? Because presumably the idea of doing index-linked or GDP-linked is they're less likely to default or less likely to give them debt reduction under some sort of, I mean, you're less likely to run into the scenario where you decide that their debt burden is unsustainable and therefore you forgive the loans like we've seen with IPEC, like we've seen with... So presumably there's an advantage for the World Bank, which is, or for the multilateral, that default is less likely with the GDP-linked or index-linked. So therefore that reduces your portfolio risk. So I was wondering if there was a way, whether you consider that or if there's a way to do that.
a purely theoretical speculation. Can you use this system as screening device? Suppose a government knows better or has better information about the growth projections. And suppose you propose to the government, you can either choose an index loan or a standard one. And can this system be designed in such a way that by their choice, the government will reveal something about the growth projections or about some information that it has more than the multilateral, theoretically?
One last question, and then we'll pass it over.
Yeah, it's probably related. At some point, at the beginning, you mentioned that it's a sort of collective agreement, so across countries and sort of a mutual insurance. And then when you show the results, you say for a vast majority of countries, the optimal share is 1 or larger than 1, but for some of them it's smaller. So apparently for some countries it's not convenient to index loans, and they may know ex ante, some kind of, even along the line, I guess he was saying in terms of screening device. So which is the incentive for some of the countries to participate? So if a country knows that they will grow, or they expect a high growth because of natural resource boom, so what would be the incentive to participate? And if they don't participate, then the pool of countries will become riskier, and then everything gets worse and worse.
Hope it works. Okay. First of all, thank you for this question, also because it allows me to touch upon some issues that I didn't have time to present. In particular, the default risk is important. Here, what we are considering in the paper is just portfolio risk, so is the proper return risk of any financial instrument. But actually, if you reduce the probability of debt default, or you reduce the probability of having repayment difficulties by this country, and therefore we know that there is some deadweight loss from this debt distress situation, then this improvement in default risk could compensate, more than offset the greater return risk that multilateral lenders could face with this type of loans. And actually, in the paper, we say that it is true there is 1% risk premium that should be paid on GDP index loans, but considering the fact that there is an externality, the fact that basically with risk sharing, what we get is lower probability of default, then there should be no need to ask for higher interest rate on such debt. I've been thinking about the screening device, because there is a paper that I think I cited in my paper. Is a paper that was written back in 1987 by Fruit et al., who was exactly looking at this kind of problem. And here, I believe that the design of this contract is difficult for various reasons. One was what Andrea was saying before. First of all, not all the country benefit from all type of indexation. In particular, there are two small countries that are better off with conventional loans. So you should actually, for all the others, at least for all the others, you may have countries that may prefer conventional. You should do for the others, but still for the others, you may have countries that may like it or may not like it. It very much depends on the design of this instrument. Why? Because in the model, the idea which is behind the empirical analysis is that the baseline trend is equivalent to the conditional mean in the estimation. So we are looking at deviation from expected GDP level, deviation from expected export, that are different depending on the countries. And of course, setting a different, setting in a loan contract a different baseline trend for each country would really be a mess and would lead to negotiation between the lenders and the countries, because the country would always like to have higher baseline trends. Higher baseline trend means basically that the loans is more concessional because it automatically reduces the payment. Is that the denominator? So, but what I think Ugo is suggesting is that there's no. We can simply have a baseline trend which is the same for all the country. Country would be eager to apply. Because still they are concessional loans, but if we give them the choice, the opportunity to choose whether to take it or not, to take this index loan, to take conventional loans, that you can actually run up into problems. Why? Because some country may not want the indexed loan, so risk sharing will be limited. So I think there are problems. There are problems as. And so the idea of screening countries it is a nice idea, but then if some countries actually opt out, then risk sharing is going to be limited, because we need a certain number of countries which perform more than expected and a number of countries which perform less than expected to do risk sharing. So it can work if we say, look, since now on, all the loans will be indexed to GDP. We are not going to provide, except in very special circumstances, conventional loans. And then we should see what happens. I think.
So maybe I'll ask the two questions about the Asian Investment Bank and Myanmar, given that we're not linked to the so closely linked to the paper. So my impression that the AIB, but you should talk with Wang Yi, who knows everything about the AIB, will have a different lending model. So what Alessandro was talking about loans which are highly concessional. So again, I lend you 100, and this 160 is a gift. What I expect, so the AIB still doesn't exist, so we don't know what it will do, but what I expect it will do, it will lend not a concessional rate, so it will have a completely different business model. So it will work like the non-concessional arm of the World Bank. Regarding Myanmar, it's interesting because Myanmar, at the time of the transition, had a huge amount of debt with Japan, which I think it was in yen. And there was a discussion going on at that point, which was sort of underground discussion, but it's a long time ago, so I can reveal it, in which we were trying to convince the Japanese to transform these loans into local currency loans, which would have many things, would have the diversification properties discussed by Alessandro, but also would sort of, our idea sort of kickstart a local currency debt market, because there would be some pricing, but it didn't go anywhere. So. Okay.
And I think that's a very good place to end. Thank you all very much.
So there is a coffee break somewhere in the cafeteria, I think.
And we're running exactly 5 minutes late, and so we start exactly 5 minutes late after 15 minutes of coffee break.
You're all welcome to the coffee break.
Thank you. Thanks very much. Thanks.
Yeah, no, I mean, that's a fair comment.
Because you have to do lots of different models.
As I mentioned before, you know, let's get together for the mission deadline, and then we were told, okay, we have a second run to send it to revise it all. Already on your end, and I said, okay,
So it's possible that Patricia already installed it.
You need to. I'm trying to. Is there a USB port?
Yes, it's there. Yeah. Oh, okay.
You need to load something on here?
Load. I hope it's loaded. Otherwise,
check.
we'll have to.
Are you presenting in the next session?
Yes.
Go ahead.
Oh, maybe it's you're David.
Yes.
Hi, Hugo. How are you, David?
So that's Wednesday.
So it's not there. So maybe I think on
How
the.
about this?
Okay. Very good. Session 1, session 2. You see the organization?
Well, you see,
here it is.
They're wonderful. They're wonderful. And it's not going to lock up, right?
I hope not.
Okay. Well, that's wonderful. Alicia, you have your presentation on this. At least there's your name.
Yeah.
Yeah.
There's your name there.
Yeah.
Yeah.
Okay, that's good.
So if there's a presentation.
There's a presentation there.
Okay. Yeah. No, there's 3 of them. I mean, that's we've done our job.
So yes, I can load my presentation.
But isn't that the one? Can you?
I just wrote it on the phone.
Oh, you did. Okay. Well, then maybe you upload it.
All right. So how do I do that?
I'm just trying mine first. Unless it won't read my USB thing, and I'll have a problem.
Mine is actually online, so I could do it online as well.
Yeah. Oh, okay. I'm in essentially the same situation. Sure. Pull my cloud. You know how to get the @ sign on here?
I do not.
Control.
Thank you very much, and that's all there. We're lucky.
Thank you for coming.
Oh, well, don't worry. You will have to pay for it.
What?
You will have to. Yeah, I would tax the African Development Bank for my time. The Africans are poor, but the African Development Bank is rich.
That's true. Let's go, we're running short on time.
So, I mean, I leave you as much time as I'm not going to take twice as much time because I'm doing 2 presentations. But so how much do you need?
I have no idea. I have not gone through this presentation yet.
Oh,
I
well,
don't know.
talk.
20 minutes.
Talk and talk.
It's just about the survey. If you've read the policy brief, you know what I'm going to say. I'm just going to say it in pictures.
Yeah, but you speak better English than I do, so.
That is a ridiculous lie.
Okay. So,
All set?
well, I need to test it, but if you're in a
Right,
rush.
I am in a rush. Thank you. We're next in 5 minutes.
Mais non, du coup, le temps que vous voulez, ça sera peut-être. Et qu'est-ce qui se passe après?
sort of messed up on this.
Pardon? Oui, tout à fait. Oh, on connaît bien, oui. Le menu, je le connais par cœur.
Ah mince.
Non, non, mais vous inquiétez pas.
C'est juste que
je change de temps. Oui.
C'est dommage.
Can I borrow your keyboard?
Computers?
How do I get that symbol?
Generally, you do either this, or you do either that, or you do either this. No, so we're getting close.
You're terrible at this.
No, I'm very bad. I mean, then press anything. Hello. Oh yes, bonjour. Comment allez-vous? Il me semble que je vous ai vu hier.
Oui, tout à fait.
On est juste dans un petit problème technique là.
Attendez, je vais demander la...
Ah non, je suis sûr que vous y arrivez. Non, pas la régie. Vous allez venir. Vous allez venir. Je suis sûr que vous faites ça très bien. Alors, vous voyez, nous on a besoin de ce petit arrobase. Et donc, vous allez me trouver ça. Ah, vous voyez. Ben voilà. Mais pourtant, je l'avais fait ça. Hein. Il m'aime pas.
Beautiful.
He doesn't like me.
Yeah, right. You didn't try that. It lies.
Attends, Neil, c'est lesquels
Oh, pardon, alors je viens vous resaluer. Oui. Ah bah, écoutez, 2 fois en 2 jours, c'est
Voilà, je vous donne ma carte.
Twice in 2 days.
Ma carte, ça va lui donner, voilà.
After 40 years of absence. Ok, great. Mais j'ai toujours pas de carte. Alors, we're cheap and adapté. De rien.
Comme ça, les deux, ils sont là.
Okay, so I wonder if I get this on the screen.
Yes. Well, that's going to be great. Yes, and the whole, crowd will be cheering up, and they would raise and start to sing.
Right.
That's pretty serious. I mean, the IMF here doing, a conference. Yeah, they usually only team up with central bankers. And, not serious people like us. I take it very, very nicely. I feel all excited.
Très bien.
Which is very unusual for me, but...
And you're going to be live streamed.
What? No.
Oh, you are?
I had that. No.
Oh, you are?
No, there's going to be more than 3 people.
No, it's... we're actually on the IMF website.
Ah, okay. Well,
And
all my colleagues will tease me next time. I've been working for the IMF.
I didn't know.
Yes,
Okay.
well, you don't have to.
So you know everyone?
I did plenty of wrong. On top of that, I'm in charge of IMF World Bank Relations. Now, I was supposed to go to the spring meetings, but I have another good excuse this time. But I'm having,
it's a pity
twice.
that it's at the same time.
Yeah, yesterday we announced our forecasts. It was exactly at the time when Blanchard was making its press conference. Yeah, exactly. So Azevedo was talking to CNN when he was live on CNBC. So that's what unusual. So they had to know everything about the IMF forecast, and they couldn't care less about what we do.
Are there your presentations?
There's something like that looks like my presentation. Yeah, you even have my Director General's speech to the ECOSOC, which I just finished. Oh, there's even a bigger she will, no, I won't talk a third time. Not after.
You'll do.
She'll keep the audience. I'm sure she's a showwoman.
Yeah, I already understood very well.
So we have
I kind of prepare the audience to what's coming, which is Alicia. So, no, I'm not going to speak for a second.
So you present the two papers,
Kind
one
of.
after the other.
Yeah,
On this one. Yeah. Should we sit or we'll stand? We'll sit.
Yeah, no, I can sit. But then, yeah.
Then I think you have to go there.
I guess.
Okay. Give your presentation.
Yeah, I think I can go there. Okay, welcome back. We start with the second session. Yes, I'm not here, and yeah. Yeah, especially because my name, at least for English speaker, could be a female name. So this is a session on trade finance, which has been sponsored and organized by the Asian Development Bank, and it involves the WTO, the Asian Development Bank, and African Development Bank, that unfortunately is not present, but Mark will be so kind to present his own work and also the African development work. So we'll have two presentations by him and one presentation by Alicia here. So we are running a bit late, so without further ado, I will let you the floor to start.
And since we're running late, I'm not going to speak twice as much in relation to the two presentations, so I'll just compress two presentations into one. So normally you will have a little less of me, which is good. The second thing is, you will not have in this session an Italian presenter, which is, valuable. I'm joking. And the third thing is you're not going to have any Greek letters, so enjoy it, right? And next thing, you may actually have a drink, enjoy the weather if we're cutting that short. But the main message of this two presentation is that trade finance matters, does not necessarily for you, or for you, but what we're going to try to convey is that it matters for international trade, and it matters generally for international economic activity. And what we want basically to explain is going to be in the following, and of course I have to open the following. No, we're not getting it yet, the following. Oh yeah, the young ones have to.
All right.
Can you open this? And then, where's mine? Yeah. Yeah, she's been at university. Okay, so I'm Marc Auboin, I work for the WTO. And I'm doing trade finance. I mean, in all itself, it's not fun, but I'll try to make it relatively attractive. Now, people have hardly noticed for 50 years that international trade had expanded with some finance expanding with it. I mean, no one really has ever written a paper. I mean, when you see after the great financial crisis that the academic community has really opened its eyes on it, you could hardly look at previous literature, you won't find an academic paper, or hardly find an academic paper. I mean, not the least because there was hardly any statistics about it, but it was certainly one of the most underrated subjects in economics before the great financial crisis. And I mean, still, when you think about international trade, you think quickly about the finance that goes with it. Why? Because very hardly international trade is paid cash. I mean, I'm not going to give you the details of all the surveys, but basically a very big maximum of 20% of international trade is paid cash in advance. Otherwise, the basic mechanism, and since since the old days, 200 or 300 years ago, the story is that the exporter wants to be paid at the latest at the time of shipment, right? It wants its money before it ships the goods. And in fact, before, when it took a very, very long time for the ship to attain the importer, it would want to pay be paid even earlier. So there were things called like letter of exchange or number of bills, promissory bills, and other instruments like that that would essentially express the fact that you will be paid now by someone who gives you a guarantee over the merchandise. Now the importer wants to be paid the importer wants to pay at the earliest when it gets the goods, right? So on the one hand, one wants to get the merchandise out only when it gets the money, even sometimes earlier to produce the goods for exports when it has the contract, and the other guys only when it sees the merchandise will pay. And that's generally at the earliest. Sometimes the guy will eventually sell the merchandise that it has received and then will pay. Now, someone who has to mitigate all the risk that goes with the act of exporting and importing, and initially the banker has played a role, and for quite a very long time. And so basically, take the most simple kind of operation, what we call a letter of credit, which is the importer will ask its bank to issue a guarantee that it will pay. Right, because it will pay only late when it receives the good. And so that guarantee will be endorsed by the bank of the exporter against a control of the bank of the exporter on the merchandise, right? And so that's what is called documentary credit. So you have to have all the documents that make sure that as an exporter you're going to get control of the merchandise, you can resell it, and that's very common in commodities trade. The exporter's bank basically have control over the shipment, right? If you have the feeling that the importer is not going to pay, well, you redirect the ship, and you have the right to do so, right? I'm not going to get into the details of that, but that in itself is creating a huge market. Now, letters of credit, or what we call structured trade finance, may represent, according to surveys, about a third of trade finance. We don't have really international data. The best piece of data that we have is coming from SWIFT. There's one highway, banking highway, through which international letters of credit get compulsory legal status between the obligor and the other guy. And so if you look at SWIFT statistics, you have roughly $3 trillion in transaction per annum. And you compare it with $18 trillion in value of trade. Still, when you have Bank A and Bank B exchanging a letter of credit, it goes through SWIFT. But if you have the same bank, let's say HSBC on one end, Hong Kong, dealing with a client, and HSBC London, they wouldn't go through the SWIFT procedure because it would be within the same bank. So if you extend that statistic a little bit, you might as well have something like $4 to $5 trillion in letters of credit per annum. And that is a huge number. Now, the other way you do trade finance is you essentially have intermediated or non-intermediated intercompany credit, right? So basically, and that goes well with the concept of supply chain finance or supply chains, is basically you have a big buyer and you have a number of cascade of intermediary producers, and they each order in high volumes to one another. So you have a huge exchange of receivables and payables also within a short period of time. Either the big buyer is asking, and I take here Walmart. I take here Walmart. Walmart is buying $380 billion in foreign products per annum, and it asks its bank, Citibank, to take care of all the payables, at 90 days, 120 days, and receivables that is basically involved into those transactions. And the idea in finance is likewise the same ideas in trying to optimize your actual physical supply chain. At the end of the day, the treasurer of Walmart wants to have a zero balance. Doesn't want to have any payables, outstanding payables, doesn't want to have outstanding receivable. So it's all on the bank side. It can be financed either through the bank, so overdraft and payables, receivables, and then factoring companies will take care of these obligations, take these payables or receivables as a trade bill, as a bill of exchange that is marketable. There's a secondary market for it. And again, these are huge numbers, right? And what has been developing most quickly in the past years, along with supply chain trade, is supply chain finance, which is this open account transaction, be it bank intermediated or non-bank intermediated. Non-bank intermediated is what is basically the idea. I'm sorry to go through this, but some of you may not be familiar. And since we do not have global statistics on that, we have piece of statistics here and there. I'm just explaining how this takes place. For example, the non-intermediated one is a company supplies a supplier's credit to its buyer, or the opposite, a buyer's credit. But these guys are smart. Even if they used to work together, what they would eventually do is they would go see a trade credit insurer, because it's an intercompany trade credit, and they would insure that. You have a company that is a huge company called Atradius, which then insures those credit, right? And today's main job of the big export credit agency is no longer to provide for government guaranteed credit, that is 1 or 2% of their income. It's to provide insured credit on those private sector credit or private sector enterprises credit, intercompany trade credit. Now, getting to the second slide, and then it's going to go faster. Now, once you know that, because that was not very well known, when I went, for example, for the first time to the Basel Committee on Banking Supervision to discuss and eventually negotiate a little bit the prudential treatment on banking supervision, I essentially explained to a very sophisticated bank supervisor what I just explained now. So I think this is not useless. Now, basically, when we had the big trade collapse, as you know, for those who follow the literature, we had the feeling that there was something of a financial crisis having a financial impact that had an impact on the real economy through trade. And we didn't know quite well how. So the academic community helped us understand what was this share of the trade finance gap that has left a trade gap, right? Now, the way we have been able to basically understand that there was a shortfall, apart from the econometrics of it, was the idea that, and that's a very important one, that most of the trade finance market is a short-term market. If you get a letter of credit, it's going to be a 90 days commitment. It's an off-balance sheet commitment for a bank, so it's irrevocable commitment to pay. It's just a guarantee, so it's all balance sheets. But you have to refinance it. You have to put one capital behind it, and you have to put liquidity behind it. So that's banking, right? Now, when you have to refinance something that is short-term, you have to go to the money market. You see the problem? Well, then if you haven't seen, then it's very prone to financial crisis, to dislocation. Not that the market is prone to dislocation in itself, because it's not liquid or self-balancing or whatever. It is just subject to the contagion of financial crisis that starts in the money market because banks, for one or the other reason, don't trust one another, right? And then trade finance gets caught into this, and then the first thing that happened to the WTO was this big demand from big traders. There was this meeting at the end of 2008 with Gordon Brown, and there was the big traders. I mean, we're talking Mittal, we're talking about Airbus, EADS, people saying, we can't have credit. And then you turn to the bankers and say, well, normally our LCs are being refinanced. There's a secondary market for 90 days LCs as much as there's a secondary market for 1 year LCs, and it's closed right now. Right. And it's closed. And it's even closed for EADS. So that explains why, so I'm coming to this one, that explains why the WTO was kind of randomly involved into that. Because in the international governance, no one knew exactly where to turn to, right? And then everybody, it's been the run in the academic community for statistics. How can we relate trade to trade finance? Now, the only set of statistics that existed at the time, well, there's a Mittier and Weinstein paper, which is one way to do it, which is to look at bank data, you know, the Amadeus database, for example, and then relate it to trade and see what kind of financial constraint applies to exporting firms. That's one way to do it. Another way, which I used with Martina Engerman, which is to use export credit data, the one from the Bern Union, which is the only one which is comprehensive, right? And consider that is a proxy for intra-trade credit is trade credit. So that's the insured part of the trade credit. But that's $2 trillion in flows per annum. So you relate it to trade. And that's what we eventually come with, which is not only a correlation, but a causality. I'm not going to describe this paper. And I think once the dust has settled, am I far from my time limit? No. All right. Okay, so once the dust has settled, and I'm going to skip that, what we realize is that the world, and you would expect that if you have a contracting financial sector after a huge financial expansion, that the world has not come back to normal. And although the grand avenues of trade have returned to normal, which is the financing have come back in North trade, in in American-China trade and whatever, someone has paid for the contraction of the financial system. And when I'm talking about the contraction of the financial system, who am I talking about? I'm talking about the global banks, those systemically important banks that there's two ways to do banking. Either you have a global footprint, you're HSBC, you have 150 countries, you're present in 150 countries, and you're present, basically, you have a trade representative in every single place where you actually can lodge a request for a letter of credit. And so you have a huge platform. There's another way to do banking is what we call correspondent banking. And correspondent banking, which is you have much more smaller team, and you essentially do that through your correspondent banking account, which is you are linked to another bank in the developing countries on which you do due diligence. You want to make sure that this is before you endorse letters of credit, you want to know what's in the books, right? Now, the problem of the post-crisis environment is that the universal banking systems model has been reshaped, right? And quickly. Why? Because banks had to deleverage. They had to reduce the size of their balance sheet. They had to put more capital. They had a leverage ratio. They had a number of things which, for those who were not having enough resources, they had to cut. And here again, trade tends to be subject to unintended consequences. You have a huge amount of short-term commitment. Well, the best way when you give 100 in lines for credit, for trade credit, either in the balance sheet or of the balance sheet, to reduce your balance sheet is to say to your customer, like a lot of banks have done in a silly manner here in Geneva to the trading houses, is I'm going to give you 90 tomorrow or next quarter. And some, like I'm not going to name a number of French banks, have exactly said that. And when they saw that the market keep expanding, which is the demand for trade was high, or the demand for commodities, then they tried to backpedal and say, oh, no, we're back on the market. Once the damage is done, it's done. But basically, the subject of deleveraging is something that you can understand. And from a macroeconomic point of view, I'm putting my macroeconomic hat as a former IMF staffer, with basically, in the US, banking was 25% of GDP, is less than 20% right now. I mean, that's as simple as that. But trade has continued to grow, although very, very slightly faster than GDP. And those who haven't made the right decision, well, they lost market share. The problem is in the banking structure that I'm showing is that you have huge banks that represent 40 or 50% of the market share, and when they deleverage, they are not letting enough time for those local and regional banks to take up some of the lost share. And the result of that is that the greatest selectivity of their clients, that's how they speak, is that you're going to do less SME financing in the developed countries, and even you're going to cut correspondent banking relationships in the developing countries. So the poor are paying, in a sense, for that deleveraging. And it's another of the unintended consequences. And we wanted to know how much because our members in the WTO wanted to know, they are feeling that the pricing on letters of credit or the equivalent, pre-shipment financing is going up. The number of correspondent banking, we hear numbers of 5,000 which have disappeared in the world, particularly, in Africa. They wanted to know more. So we've been in the WTO doing a little bit of surveys, and we've been asking our partners to do a little bit of surveys too, because we don't have the hard statistic. I can answer why. And so the Asian Development Bank and the African Development Bank have been doing surveys. But first, before we get into the survey thing, when you ask people, and that's WTO survey, when you ask people, what's most important for inclusion into modern supply chains, of course, inadequate domestic infrastructures, getting multimodal transportation, getting to the ports and so on, clearing customs, that you would expect, but limited access to trade finance. And when you ask either to the donors, to the developed countries, which may eventually extend finance, or to the developing countries' partners themselves, you have the same reply. It's not something that we discover. Again, we're a little bit, I'm also doing some papers, a little bit of Greek letters from time to time, but that's something I sort of pride of, because we're listening to traders too, having discussed quite early with the rest of the international community. And we had a mandate from the G20 to look at trade in low-income countries. There's something structural also, the lack of development of financial sector in new frontiers of trade. That's something we can discuss. And then there's something, I would say, conjunctural, where the market does not clear and the big banks have pulled out. But the two together have a strong effects on the lack of trade finance at the present moment. Again, some more survey. The CBI from the Netherlands, showing the extent to which trade finance forms an obstacle to trade, and access to finance also coming on the top of the WEF, Global Enabling Trade surveys. That's some prices. If you want, if you want a trade loan, that's annually. Trade loans are usually less than a year, but that's telling you that's above inflation. Huh? So whatever the inflation rate is, this is what you're going to pay. So don't tell me there's a market failure here. And so we're typically also in an industry where there's a big gap between the perception of risk and the actual level of risk, because when we have something else I can tell you is that when we've talked to the profession and they've said we're a very safe, probably the safest financial activity in the world, well, we said prove them. And they put a repository together, thanks to the Asian Development Bank also, a repository of trade finance transaction. I cannot see, if I had this transaction level data, I would be the most happy economist, but there's 14 million transaction level data into it, and it's completely locked by lawyers. But basically, it's there to calculate loss given default. And loss given default on trade finance is 0.021. That's 40% less than real estate in America. And so when you see these rates and the level risk, you say it's not matching. There's something wrong about the market. Right. I could show you more of this, but basically, we've been trying the next stage is our members have been quite convinced that this was important, so we don't need to go any further. We had a seminar last week. I'm sorry. The guy who's important is this one. So that's Azevedo. Please go on our website. You will see his speech. He's going to try to make trade finance as part of a serious part of the UN financing for development agenda, and we're going to push very hard. It's even coming with trade facilitation on top of the agenda, because this is, as you can see, one of the two key precondition or enabling condition for traders to trade. But then, and that's my last remark, that's where the African Development Bank normally comes, we have been trying to put a number behind the trade finance gap. And that was the most difficult thing to do. That's where Alicia has been doing a fantastic job, and that's where I need to find the other presentation. Here you go. Mr. Usman, and that's African Development Bank surveying the banks in Africa. And what you see in Africa is there's a lot of development of banks that are actually doing trade finance. So it's not that the knowledge is very complicated to obtain. You still have some challenges in new countries. I'm going to go to Myanmar here. You know, indeed, handing a letter of credit is something really new. So we're sending the IFC, we're sending the Asian Development Bank, and they do training, right? But in their response to the survey, 300 banks roughly in 45 countries in Africa have said what they are doing. Well, 93% of them are doing trade finance, as you can see. And we've been able to sort of give a number on the size of the market in trade finance. He's been a bit wrong about exports, but African exports are around $700 billion, so 350 financed by some finance, trade finance, is about half of African exports. And still, more than half of African exports are oil. And oil is always completely tied with letters of credit. I mean, there's no finance on this. I mean, no cash payment, right? And off-balance sheet transactions are LCs. Huh? Now, what it tells you there is basically, I'm sorry because I'm not the one who is supposed to make the presentation, but what they have tried to estimate in the survey is the amount of trade finance which has been requested and has been rejected by those banks. And they come up with a number of 110 to 120 billion dollars. So that is 1/3 of the actual market for trade finance. And so there's high unmet demand. Now, what are the reasons for this unmet demand? There's the lack of credit worthiness, or even more, I think that's a very important, lack of credit history. And that tells you something about the risk attitude of banks in developing countries, or, you know, which do not necessarily have the kind of credit analysis tools and all of that. Very conservative. And I've been, you know, res rep in a post-conflict economy or in developing countries. You can see that the banks would go to prime rate, you know, customers, prime rate companies, established companies. But you have other things like insufficient limits with confirming LCs, reassuring banks. It's a complicated word to say not enough capacity to get, not enough correspondent banking capacity. Balance sheet constraints, it means you're too small. You know, there's a size effect which is important in banking. Trying to find something interesting to say. You can see that it's a fairly concentrated market. I repeat myself, but 40% of the market where I have been talking about trillions of dollars are global banks. And before, I mean, for example, we had in our WTO seminar 2 weeks ago, we had Standard Bank of South Africa, largest bank in Africa, right? They have said we are ready to take up market share. When you see the size of the balance sheet of Standard Bank of South Africa, you're bank 15 in France, right? So they will take as much as they can, but they can also over-leverage. So there's so much you can expect from them taking up that market share. In China, well, Bank of China has now pretty much the balance sheet of HSBC. So, and still, the average non-performing loan rate in Africa is 4%. So you've seen the rates, you've seen the gap, and you've seen the very small non-performing loans at the present moment in the US is 7%. For major banks, we're talking about JP Morgan and the other ones. So I guess I'm pretty much through. Alicia will give you a feel of what's happening in Asia. Here the need is even bigger because trade is growing the fastest. Now the problem is the following. If we remain in today's world where the growth of trade is not much faster than GDP and the financial sector stabilizes, well then eventually the market will clear. But if we hope the new frontiers of trade, you know, the Ethiopias, the Myanmars, the already Vietnams, continue to grow, that if the capacity of the international producers to reallocate comparative advantage according to task continues, and it will continue, in my view, maybe slower, because there's not going to be any more China or any new phenomenon like China, but that will continue task by task, then the capacity of the financial sector of the individual new frontiers country is certainly no match to what it was in China. Think of it, China has a savings rate of 40% to GDP. They were ready to intermediate anything, and certainly trade. Now, when you look at the savings rate of Burma, 12% of GDP, or anything else like it in Africa, it's not going to be the local financial sector. So if it's not going someone else, then there's going to be delays. It will be longer to have development of the trade sphere. And it does not apply only to finance. The infrastructural development of trade will become a bit slower than it has been. And we are thinking about that as trade economists. What does it mean for the trade and GDP relationship? What does it mean for other things? But the financial part is one that we care about. And it's done.
Please. So maybe we let her present, and then we can collect questions after the second presentation.
Okay, can I start? So I will totally not be talking about Asia. I will be talking about global gaps, but with reference to Asia. Okay, so ADB does this trade finance survey. We've done it for 2012 data, 2013 data, and we're doing it now for 2014 data. And what we're trying to do is we're trying to sort of figure out what's going on with trade finance globally post-crisis. So, we have a lot of literature that looks at sort of financial constraints, it looks at credit rationing, that kind of stuff, during a crisis. But we don't know a lot about what happens during normal periods. So, I am so glad that Mark went over all the boring stuff. I'll just skip that, assume you know trade finance very well already. So we know that trade finance can constrain growth both for countries and for firms, but we don't know so much about why. So some of the questions are, for example, is it a problem of availability? Is it a problem of price? Is it the regulatory environment? Is the borrower, the lender, is the bottleneck? And so these are some of the sort of questions that we seek insight into. And of course, the answer to whatever these things are changes everything. Because as Mark was sort of talking about, trade is an engine of growth. We know this. But trade can't happen without trade finance, or the majority of trade can't happen without trade finance, in particular for the types of countries that ADB is concerned with, which is our developing member countries. Okay. So first, what I'm going to do is I'm going to talk about 4 facts about trade finance that we learned from our survey. Now, I'll sort of like briefly go into the survey instrument a little bit. So it's a survey of, we have a provider instrument and a user instrument. So the provider instrument has sort of 3 different populations. We survey banks, we also survey forfeiting companies, factoring companies, and credit insurance companies. And then the user instrument, we survey private firms. Okay. So, as I just said, gaps don't only exist due to shock. So our global gap estimate, $1.9 trillion. Mark hates this. That number is huge, right? That's great. So Asia in particular is one of the greatest sources of the gap because it does face a rejection rate of 79% of trade finance proposals. This is similar to Oxford University's rejection rate of its undergraduate applications. Yes, that's right. We are very restrictive here. So this is just sort of some technical issues. I'm not really going to go into this because this is kind of boring stuff about how we project and stuff like that. So basically what we do is, in order to get the gap number, we survey a bunch of banks, and then we weight their responses by their assets, and then we project that onto global bank assets to sort of get a global gap number. Okay, so this is what the gaps look like by region. You can see on the left is the trade finance that they've proposed, and on the right is the rejection rates. So you can see Asia both proposes the highest proportion of trade finance and also gets the highest proportion rejected. And this is very much concentrated in India and China as well. Okay, So I was hoping my African Development Bank colleague would be here so he could complain about my numbers as compared to his. So the Americas gap we got using this data is about $20 billion. The Africa gap we got is $60 billion, as opposed to his 110, 120. But our numbers do move in the same direction. So, you know, one of the things about gap numbers is we're measuring all different kinds of things. Mark was talking about, you know, sometimes you're measuring letters of credit, sometimes you're measuring other instruments. So the way that I try to think about this is as long as we're moving in the same direction and the trend is the same, then we've kind of got some idea of what's going on. So our Africa gap number for 2012 to 2013 sort of reflects the same direction as his 2011, 2012. And then, of course, the Asia gap we have as 1.6 trillion. So this is fact number one. Gaps are widest in Asia. And here you can, this is just sort of like a very small breakdown of developing Asia and then separating out India and China. Because, of course, this is sort of the population that we're most interested in. How's everything going? Are we on board with what I'm doing? Yes? Okay. I know, this is really boring, right? It is hard to make this interesting. Okay, so first, gaps are widest in Asia. Second fact, SMEs engage differently than other types of firms with the trade finance process. They're rejected more often. They don't really try again after they've been rejected, and they tend to be very unfamiliar with different trade finance products. So the high rejection rates are, of course, compounded by the lack of information. So here's some rates of rejection. So we can compare SMEs and non-SMEs. These are, okay, so I divided trade finance products into sort of what I call traditional products and non-traditional products. It's kind of a weird way to divide them, and the literature is sort of thinking about how to do this, but close enough. But anyway, so what you can see is even in traditional products, SMEs in every case have higher rejection rates than non-SMEs. Of course, makes a lot of sense. They don't have collateral. They tend to be less developed. Okay. So, but here what you can see is that SMEs are familiar even with sort of long-standing traditional types of finance. Oh, actually, this is the wrong figure. All right. So what you can see in this figure, in fact, is that they are unfamiliar with new types of finance. Supply chain financing, BPO, forfeiting, and factoring in particular. So this is the sort of multinational corporations and their familiarity versus the SMEs. And you can see, you know, in something like factoring, which is not exactly something like really, really new, only 39% of SMEs in our survey were familiar with what that was. And if you go to forfeiting, 16%. I mean, this is really a problem. Okay, so SMEs engage differently. So sort of related to that, what we know now is that we're really in a period of innovation in trade finance products, right? Because we sort of recognize that there's this need to sort of move forward. And so here I kind of talk about supply chain finance a little bit, BPO. But innovations are really underutilized. You saw that in the previous figure. That was the wrong figure. So here we have sort of trade finance gaps by transaction type, letters of credit, working capital, supply chain financing. And what you can see is these are all relatively new instruments, and the rejection rates are fairly low for most of them, as compared to the letters of credit, of course. So we know that there's low rejection rates for a lot of these new instruments, but very, very limited use, particularly among SMEs. So that would be the third fact about trade finance. New instruments have limited reach. All right, fact number 4. Rejected transactions are not resubmitted. Okay, I know this sounds really boring and unimportant, but in fact it's interesting. Because what we found is that less than a third of firms who have rejected trade finance proposals even try again. So one of the problems with our previous surveys, people kind of said, oh, well, you don't know if you're measuring something over and over. So maybe, I get rejected at one bank, I go to another bank, I get rejected again, I go to another bank, I get rejected again. So then all of the banks are counting the same transaction. But we found here is firms aren't really doing that. They get rejected and they don't try again. So what we asked them here is where you did seek alternatives, what happened? And this is just kind of a breakdown for Asia and Africa, just to see if that said anything interesting. And we find in Asia is they tended to find alternatives, but they were too expensive. Whereas in Africa, they just didn't find anything, any alternatives, when they did seek sort of an additional source of trade financing. This is interesting. Okay. So those 4 facts lead us to the 3 drivers of persistent gaps. These are low credit rating, information asymmetries, and AML KYC, which is sort of due diligence requirements. So what we did was we asked our banks to tell us what were the greatest impediments to providing additional trade finance. And this is, I think Mark showed like 3 of these figures. Looks the same as his. So, basically what you can see is that AML KYC consistently came across, these are proportion of the banks that rated these things as significant or highly significant. So you can see AML KYC was by far the most significant, but then these sort of low credit ratings, low country credit ratings, these things were also an important category. So AML KYC, huge problem. We found that here, this is just some numbers, right? 50% of banks in Africa and Asia tagged this as the greatest constraint. 32% of the banks answering our survey terminated correspondent relationships, and 68% of banks declined transactions. So what this doesn't answer, what our survey in 2014 didn't answer, is what proportion of these declined relationships and transactions were because of findings of noncompliance. Sort of anecdotally, they're not because of noncompliance, they're because it's too expensive to check for compliance, but we didn't ask. So we're asking this year. So you come back to me in like 2 months and I'll be able to tell you the answer, but right now I don't know. Okay, so why is this such a problem? Well, the high cost of compliance. So here I just kind of stuck in some numbers, mostly resulting from the HSBC problem in 2012. Also, compliance is very difficult in countries with weak financial governments, so Bangladesh and Nepal, for example. This is where finance is needed most and where it's most difficult to get these sorts of types of information. And the third reason that this is such a problem is the large sanctions decisions. And this is sort of, I go into kind of behavioral psychology here, the overestimation of risk. So you have these sort of 2 very, very big payouts that I just listed here. These are huge. Banks don't want that. So they're becoming overly risk averse as a result. It's unlikely that these types of large payments will happen again, but because they happen once, banks are not willing to go in again. Okay, so that's AML KYC. Low credit rating, we all know what that is, so I think I won't go through that. And finally, information asymmetries. Now, information asymmetries are interesting because this is not a constraint in supply, right? This is not a problem coming from banks. This is actually a constraint in demand. This is the fact that firms are not requesting certain types of finance because they don't know it exists. So what we did here is, dividing traditional and non-traditional types of financing. This is how many, percentage of firms answering the survey. We had like 500 firms globally. Were familiar with these different types of processes. And so traditional financing, pretty good. Non-traditional financing, very limited. And this is all firm sizes, not just SMEs like I showed earlier. So this is a real problem. And in addition, we found that 78% of our reporting firms said that they would benefit from greater financial education as well. So that is something that development banks should be doing. All right. So that leads me to the last slide, was this need for economic development. I came up with 4 conclusions. The first is inelegantly worded. Trade finance is lumpy. Where it works, it smooths productivity, employment, growth, but where it doesn't work, which is for SMEs, and particularly for high-risk developing countries, it's in fact becoming a trade constraint. The governance of trade finance exacerbates these types of gaps, particularly for the weakest populations. Second conclusion, that there is a positive relationship between finance and job creation. This is not the most rigorous way to measure this, but it was the best that we could do. So we asked firms, if you had so much more trade finance, how many more people would you hire? How much more production could you do? And so what we find is, effectively firms have said that a 10% increase in trade finance would enable them to create 17% more jobs. That's pretty good. But of course, it is simply, this is not very rigorous data. Okay, so third, there is a huge space for multilateral development banks to start providing more public goods via guarantees. By guaranteeing transactions, multilateral development banks can facilitate trade, particularly in high-risk markets. So, by doing these types of guarantees, not only do we produce information about risk profiles, but in the case of ADB, because of course I have to say this kind of stuff, it's helped to establish country limits for Mongolia and Bangladesh, as well as it helps the local banks sort of learn the process as they go through due diligence to learn about the potential things that correspondent banks are going to look for and to learn how to do those things. And finally, South-South trade is artificially constrained because the banking relationships, at least in our case, between Asia and Latin America, nearly non-existent. In particular, with Asia, unless you're China, Japan, Singapore, or South Korea, you probably don't have any banking links to Latin America and Caribbean. And finally, without sovereign risk ratings, not very many confirming banks will do deals with any country. So while you may have the situation where a local bank will provide working capital, it may not be able to create the relationships with the confirming bank. And so this is where the multilateral development banks come in. Okay. And that, my friends, is the end of this presentation. Thank you very much.
I think we can open the floor for discussion. 1, 2, 3, 4. The microphone. A volunteer.
Yeah, thank you. Thank you very much for your presentation. Yes, you said that you have a mandate from G20. Can you elaborate more? And you said also other thing very interesting, that Roberto Azevedo initiated human financing agenda. Isn't it? This is what you said, Mr. Marc Aubois?
Can you repeat the second one, please?
About a human financing agenda. This is what you said? Roberto Azevedo, the DG, WTO DG, initiated. No? You said that or no? Yeah. Yeah, other thing, yes, I have another question for the lady. Yes, a banking relationship between Asian countries and at least Asian countries, because in this issue and mainly on international trade, we are also focusing countries with LDCs, least development countries. And as you know, for example, Bangladesh is a leadership for LDCs. And it's another perceptions of, this is more comment than the question. But my question also, lastly, yes, because in WTO, we talk often on aid and trade. And in this conference, we are talking on financial for development. How about financing aid to trade? And I stop here. Thank you.
Over there. Yeah. In the meantime, I have a number of questions thanks to the just there? I was thinking over there. Okay. So that's why I was talking, because I was expecting you to walk all the way down there. But I can wait and let the floor talking. No, talk.
Okay, 2 questions, 1 comment. Okay, question 1 is, besides the bank, what happened to the government policy to subsidize the trade? For example, I use the US as a case. We have Export-Import Bank of America. In China, we have Export-Import Bank of China. They support export. Secondly, if you look at subsidies, you see a lot of CL, certificated letters, provided banks a charge for export sectors, which happens when the country's industry policy try to promote the export. They pay half. The government pay half. The export sector pay half. before crisis. Now, if a country like China start to change the growth patterns, get rid of, switch from export sector to domestic, a question mark whether it happens. This is my key, first question in terms of government, development bank, domestically support, subsidies policies. Secondly, financial innovations. If you look at the financial innovation, from online tradings, like eBay, Alibaba. They do this online trading, they provided credit or sort of insurance to the export, to the buyer or sellers. The size is bigger. We missed something here. Last but not least, most things we teach students in academic side, selection bias. If we only look at left-hand side, rejection rate, we need to know why. It's because fundamental, it's because of the reasons, because you guys have most amazing data. Any serious study to see what's reasons? Okay, thank you.
Oh, now I wait.
Good.
Thank you for your presentation. My question is regarding SME financing, given LDCs are generated by SMEs for the most part. And I was curious as your views on the future of public-private partnerships, given IFC and Goldman Sachs created a $600 million lending facility for women-run SMEs last year. Gender has not been noted, women-run SMEs in particular, as an issue in terms of trade financing. And I'd like to hear your thoughts both on that aspect as well as the future of public-private partnerships. Thank you.
There's one question here. 1, 2, 3, 4.
Hello. Hi. Sorry, I thought I was third. Okay, sorry. My name is Emilio Hernandez. I'm from the Food and Agriculture Organization, and we in our everyday work we bump a lot with trade finance. It's a big instrument that's used for commodity exports in many of our countries where we work, and I have comments and questions. My comment is that in our experience, we feel that there are demand and supply constraints to the expansion of trade finance. And if you look at Latin America, Africa, and let's say Southeast Asia, you always go back to the issue of the fundamentals preventing an expansion of trade finance. No matter how much you try to promote the supply side of it, you always end up with the issue of having these clients really being able to comply with the requirements of the big buyers. But you have a big segment that I think you're capturing your data of those that are kind of ready to participate, and the supply sector, the supply side is especially in these countries, are not able to assess. And what we've noticed is that they incur into extremely large, expensive credit insurance services to be able to work with most of these clients, which I wonder if it's one of the main reasons why you see such a high cost of trade finance, despite the very low risk in this particular type of countries. I would just want to hear your comments on that.
Thank you. Just on a practical level, I thought the new policies of the World Development Bank was not to actually secure sovereign debt guarantees in terms of financing for infrastructure projects. Could you just perhaps elaborate on that? Because the sovereign debt guarantee model doesn't work. And I think the World Development Bank now is projecting new models, but I don't know what those new models are. But could you perhaps offer some comments on that, please?
You mean World Bank or Asian Development Bank?
World Bank. Yeah, because sovereign debt guarantees, often it's very difficult for the countries to repay those, and the GDP isn't rising in terms of growth fast enough. So certainly last year that was not projected as an ideal model as such in terms of securing infrastructure development funds and FDI for infrastructure development at a country level. Thank you.
sais pas ce que je peux parler en français. Ça va? Ok, allez, go. Je vais parler en français. Je viens d'entrer à la Birmanie, en fait, il y a 3 avril, il y a quelques jours. En fait, comment ça s'appelle? Comme la banque en Birmanie, je suis allée là-bas, et la banque Birmanie, il n'y a pas la relation entre la Suisse directement. Il y en a une banque qui est la banque Myanmar, et pour transférer l'argent, en fait, avec le LC, il n'existe pas, en fait, on travaille que la trade, en fait que le TT uniquement. Il n'y a pas le comment ça s'appelle, bill of lading, on n'a pas du tout. Et ça, c'est un gros problème en Birmanie, c'est qu'on ne peut pas amener, en fait, jusqu'à le port. Pour le moment, ce qu'il fait, c'est que beaucoup de Coréens qui sont rentrés, ils font uniquement, qui travaillent des usines là-bas en Birmanie et qui fait du pick-up toutes les habits, en fait, depuis là-bas. Il n'y a pas de ni CIF, ni FOB, rien du tout. On a même jusqu'aux usines. Ça, il y a beaucoup de problèmes, c'est qu'on veut développer ça et comment on va faire. Ça, c'est la question, c'est la banking. Et on a beaucoup de problèmes, ce côté-là. Quand je suis entrée déjà il y a 4 ans en arrière, et ça fait bientôt 6 ans que je rentre tout le temps. Alors là, ça, c'est ma question, comment on peut le faire? Ça, c'est ma question et profonde, quoi. Voilà, merci.
Do we maybe want to reply and then we collect a few others? Otherwise, you lose track.
I think I have 21 questions. G20 mandate, that's been the basis on which we've been working, as a matter of fact, not only our members. We have a committee in the WTO, which is called the Working Group on Trade, Debt and Finance, where trade finance has been identified as one of these areas of joint international governance. Of course, we're working with the World Bank, IMF. Each of them has a sort of division of labor. The IMF is bringing, surveys and analytical support. The IMF used to be quite involved because a lot of the trade financing in the very old days was government guaranteed. So when there was a restructuring of sovereign debt, government guaranteed commercial debt was, under Paris Club or even London Club restructuring. Now, as you could hear, most of the market for financing is private, even for credit insurance. Old export credit insurance agencies have 99% of their business private in the developed countries, and they represent the bulk of global transactions of those $2 trillion I was talking about. DG's involvement, Director General's involvement, it started indeed with Dr. Superchai in the WTO after the Asian financial crisis. What happened, the very first thing that happened in the Asian financial crisis was this dislocation of the financial sector. Think of it in Indonesia, it sort of collapsed from one day to the other, and basically, in the island of Batam, where they're assembling the Nikes with parts from Korea, the banking sector could not issue LCs for the companies to get the parts in Korea to be assembled on the island of Batam and being re-exported through Singapore. That's as simple as that. The central bank had to put in the big banks of Singapore deposits so as to guarantee any letters of credit issued by any firm, Indonesian firm at the time. Although they were the orders, there was not the financing or the financial sector to supporting these orders. And at that time, there were a number of experiences, starting with the Asian Development Bank providing for what they do now, which is guarantees and other products. Central banks were also providing for what factoring companies do now, which is discounting even contracts and giving cash against it, and then they resell these as securities on the market, and other things which gave the international community. We had a debriefing session, by the way, at the IMF in 2004, which led to a number of ideas, one of them being that the international institutions would develop these guarantee programs which help SMEs to get either during periods of crisis or out of period of crisis, because the problem is largely developmental, but also is countercyclical during periods of crisis, of financial crisis, would help the SMEs get guarantees on their LCs and
trade will continue to flow, or at least it will fall less than the financial sector would lead it to fall. So DG's involvement, Lamy very strong during the crisis, which led to a G20 mandated support program, which was essentially provided by governments in various forms. There was export credit agencies getting back into the government guaranteed program mode for a limited period of time. There was a sunset clause. This was under G20 in London that lasted 2 years, 250 billion in extra capacity for trade finance. Central banks, for example, there was a shortage of dollars. Very few people know that 80% of international trade is done in US dollars. So when there's a shortage of dollars in the money market in New York, there's shortage everywhere. So basically the Fed has established 14 swap agreements with the main trading centers in the world, and has some central banks have opened discount windows, and so on and so forth. DG's involvement, today's DG's involvement is with the idea that this is a fundamental development issue that is important for traders. It is complementary to what we do in trying to reduce trade costs by way of doing the trade facilitation agreements, by way of negotiation, but this is something that also has its importance, and I encourage you to damn it, it's only one question. Aid for trade. No, but I think it's all linked. Policies to subsidize export. Yes, there are export credit agencies, and I guess that Sinosure and other Chinese institutions are rich enough to subsidize, part of Chinese trade. But the fact of the matter is that today's trade is mostly private owned, that export credit agencies do not have the capacity to, as you can see, on the private basis, they do insure essentially $2 trillion of the $18 trillion of trade. And so now it's true, that's because it's largely private, because they some of these companies take advantage of their sort of leading position on some market. They're able to charge high rates for very little level of risk. And so that is an indicator of the market failure. We, as an institution, have been, let's say, pushing for public-private partnership. For example, there's an African trade insurance credit agency in Kenya, which is in fact a joint venture between countries in Africa, the World Bank, which have paid the equity share of these countries into this export credit agency, but they operate on commercial term. Bladex, which is another institution, works for Latin America. It's based in Panama, and it's a joint venture of countries. It's export credit agency. So these relatively small, commercially based institutions with public stakeholding, and after all, what are the multilateral development banks doing? We are going in that direction, definitely. And the G20 has encouraged us. There is clear languages in the ones of, Seoul, in the ones of London, and the one of the various institutions. Commodity finance, yes, the next supply chains to me are in the food area. I mean, indeed, today, very large banks are holding a lot of the market for financing commodities. I'm not going to mention them, but they do a good job, and very often they have the high savoir-faire to be able to originate deals and to basically follow the supply chain from the seeding, the financing of the seeding, to the exporting of the good at shipment, at the area of shipment, including also warehousing. They are responsible for it. They're essentially responsible for it. Now, when a big bank disappears from the tour de table, and I have at least 2 examples, for example, cotton in Ghana. Cotton in Ghana used to be financed, the entire crop used to be financed by one very, very, very large bank in the world, if not the first one. And they've decided not to touch it anymore. For various reasons, we can talk about it. We wouldn't find anyone. We wouldn't find anyone to take that risk, and they finally it's the IFC, the World Bank, doing it. And actually the IFC, which is the private arm of the World Bank, has to change its rules now to be able to deal with some of these export boards of governments in developing countries. I think
I mean, there are issues about compliance. There are issues which can get us in pretty much a lot of details. But I think demand-driven, supply-driven. I mean, trade finance is demand-driven. I mean, almost 100% of it, except in the poor countries, and except during financial crisis, where the supply side acts. It's not a lot. I mean, the shortfall in the financial crisis was estimated to be anywhere between $200 and $350 billion out of, what, $14 trillion? But when it's there, the financing is there, you don't hear about it. When it's not there, I can tell you, you only hear about it. In the trade community, you only hear about it. So that's something that we are taking care of. But it's essentially demand-driven, certainly. Online trade, these are other issues. We have thought about it, but it's fascinating. And financial innovation, I think I'll lead it to my partner here.
Wonderful. Thank you. All right. Let's see. I'm just going to sort of glance over some of these questions really quick. In terms of public-private partnerships, yeah, that's a big focus of Asian Development Bank now. We love them, really trying to push for them. Don't really know how to do them. They are a lot more complicated than they sound. All right, in terms of sort of some of the questions about SMEs and supply side, one of the interesting things about our trade finance program is we do not specify that banks that we're providing with guarantees need to work with SMEs. Yet almost all of the transactions under the trade finance program go to SMEs, which really speaks to the fact that that's a market that is constrained and that is directly helped by this. In terms of supply chain finance, this is really sort of the next frontier for ADB. We have our trade finance program that's very well established. The supply chain finance program, we're moving into it, but we understand how to work with banks. We don't really understand how to work with companies yet. So this is an area that I don't really know where that's going to go for us, but it's certainly on the list. In terms of sovereign debt guarantees and stuff like that, I mean, our trade finance program largely works with bank-to-bank finance as opposed to government finance, so I can't really speak to that. One interesting thing, that I kind of thought about when you were talking about China and domestic trade is if you look at the data on factoring, China is actually the fastest growing market for factoring by far. But if you look at international factoring, Asia doesn't even show up. I mean, not at all. So, there's one area where you sort of have this movement in the domestic sphere that hasn't yet sort of pushed into trade, but where you do see these sort of very interesting changes. And I think that's it. I fold.
Okay. Do you have other questions? No, David is gone.
No, it wasn't.
Went over there. There is Chris, anyway.
Since there's a chance for one more question. This is mainly for Mark in response to a comment he made, which is this nice notion about the extent to which growth in trade is exceeding growth in GDP and growth in the financial sector. And it strikes me that there are sort of three factors that are, at least three processes underway, and I would just like to get your sense on this. One is the growth in trade and services and what differential demands that makes on trade financing, because obviously in one sense it closes, I guess it closes the time and distance gap somewhat compared to merchandise trade. The second is the growth of vertical integration. You talked a little bit about that in if you think of agriculture and the growth of the kind of the industrialization of agriculture, to what extent that internalization of previously external trade linkages plays into the story. And the third is, I suppose, the offset is the growth in trade and services, or trade and tasks, the greater fragmentation of supply chains. from a WTO sort of perspective, when you look at this, how do you see this netting out? Where, over the next 10 to 15 years, the scope for economies of scale and scope in trade financing, given these structural changes in the pattern of trade? So it's asking for a bit of speculation.
Can I add one
Yes,
question? Maybe, yeah, I was a bit kind of concerned about these differences that we've seen in the numbers between the two presentations and some other numbers I've looked around. And when you presented the data, it was very quick. And it seems to me that the bank, you cover something like 25% of bank assets. So it seems to be not a huge number. And secondly, given that, it could be even okay, 25%, but do you have a sense at least of how much it's representative? So we call regionally or over time, or, if you can given the banks that you have in your sample, you can replicate, at least aggregate kind of flows that you see in the data. And also on the firm side, how many firms do you have by country? So given a bit of a more indication of how representative the survey is. And in terms of the results, I have one thing that struck me is a number of findings that you find about SMEs. You're pushing a lot. It's basically what we already know from all the banking literature. So the fact that they don't know, there's a lot of asymmetric information, they don't know the instruments, there is higher rejection rates, there is a lot of discouragement effect. It doesn't seem, I would like to understand if there is something new in trade finance which we don't know from basically bank-firm relationship for SMEs, especially in developing countries. Final thing is, instead of, you were very brief for something, two issues which to me seems very relevant. In one of the slides you mentioned that one of the policy lessons and the role for multilateral institutions could be to provide guarantees as a public good. So if you could add a bit more on that, how do you think this could work? And coming from both presentations, I think, in terms of policy, which would be, so what do you think it could be done to, for instance, reduce all these problems of lack of knowledge by the demand side of the market, so business support, business training activity, business support activities. So what do you think it could be done? Other questions? No. Yes. No? Yes. There.
Je ne sais pas si c'est une question, mais je vais le dire en français, parce que je n'ai pas assez de vocabulaire financier. Je ne sais pas si c'est parce que les transactions qui sont rejetées, si c'est pas parce que le circuit bancaire n'est pas assez développé dans ces pays-là, par rapport à nous. Nous, je veux blesser personne, par rapport à nous où on a, comment dire ça, tout ce qui est la bourse, le SWIFT et tous ces trucs informatiques. Tandis que peut-être qu'eux, ils n'ont pas beaucoup de comptes avec soit le public ou bien les entreprises, mais que c'est plus du donnant-donnant peut-être, en cash ou je sais pas quoi. Et puis il y a peut-être une différence entre le BRICS et puis l'autre au niveau européen et américain, quoi.
Okay, moderator, your questions. So first about the banks. Okay, so what is really difficult about this data is that we can't identify any banks. We can't, because this is proprietary confidential data. So it's, what we were able to do, we were able to weight them. Because
you cannot share, but you know.
Yes.
Okay, so you can provide statistics.
Yes.
You cannot name names, but you can say.
Yes.
On aggregate.
That is correct. But so for the banks, the way that we gather the data actually is we go through the ICC, Banking Commission. They have an annual survey. And so our questions go out through their annual survey. So we actually don't have a whole lot of control over who answers it. and sort of what sort of answers they have. So it's representative in that it includes the largest banks, and it does include a fairly good global sample of medium-sized and small banks. But I can't really sort of go into a lot of detail about that. And that's actually sort of more a problem in the data as well. So, I can't ask banks, how much trade finance was proposed to you last year. And part of this is because they won't release it, and part of it is because they simply don't collect it. So, trade finance requests go to a whole host of different spots in a bank, and a request is not necessarily collected, right? I mean, it might be a phone call, and I say, no, don't ever call me again, and that's not logged anywhere. So a lot of this is just sort of estimation. We don't even know if we're hitting the right people in the banks. So that's why I tried to stress these numbers are trends. These should not be taken as absolute positive numbers. Okay, in terms of the firms and how representative they were, the firms that we surveyed last year, we got through, no, the firms were not representative particularly last year because they were banked firms. They came from our banks, and they came from CBI, which works primarily with SMEs. This year, the firms are coming through a stratified sample from ITC and from CBI again. So what we're going to do is this will be globally representative, and it will include sort of a good representation of small, medium, and large firms. But in terms of the previous surveys, it didn't. And this is an issue. We're just trying to get as much data as we can. We have nothing. We have no data. So this is our effort to try to get something. So actually, I can point that out as well. We had this survey in 2013. It was awful. If you have ever read it, don't tell anybody about it. It was really bad. So the survey we did last year sort of corrected a lot of the problems we did in the past, and the survey we're doing this year is much better still. So this is for us, an iterative process, and we only sort of try to do very incremental changes because, of course, we want to make sure that where there are useful questions, we're able to ask them over time without so we can sort of create time series, and at the same time improve the sort of problems that we found in the past with, sort of response rates and things like that. I think that was everything. Yeah.
Thank you very much. On trade finance data collected and what we can collect in terms of hard data, and here I'm speaking to more the economist crowd, we have been thinking about it. There's two ways internationally you can know about these kinds of banking flows. One would be the balance of payment. So you will have it in short-term capital flows because, as I told you, the bulk of the market, like the bulk of trade, is short-term. Right, and so the problem with BOPs is that for very many countries, including European countries, they have left and removed exchange controls. When you used to, under exchange controls, when you used to export or to import, you had documents and you had its financing. And of course, obtaining authorization on its financing would be important, and it would go through a certain process, but it would be there, well marked into your customs documents. Since most countries have gotten rid of exchange controls, they no longer collect the banking information that is going with the transaction, right? Some do, like Turkey, and then when the data is there open to economists, that's great because then you can do some great regression work between trade and its financing. Now, the other way you can look at it is cross-border banking statistics from the Bank of International Settlements. And we've been talking to them, as a matter of fact, to the BIS. And basically, when you look at these short-term capital flows around the world, it's around $40 trillion. So these huge numbers. And after the financial crisis, we realized that, statisticians realized, both BIS and IMF statisticians, who are only there to also promote cooperation between their members, realized we knew very little about the composition of these capital flows. And so the BIS, for example, has engaged into a gap-filling exercise. And when we ask them about trade financing, because in these $40 trillion of short-term capital movements, you probably have 10 of them will probably be trade finance, LCs or non-LCs or whatever, open account financing and so on. But basically, they've thought hard about the problem and they say, look, you know, I have to re-regulate the financial sector. We have to know what we do re-regulate. So what we're looking at at the present moment are the leverage transactions, the derivatives, and that's probably some kind of $10 trillion. So please wait a little bit. So we're waiting quietly, probably because we are not the most risky transactions, if we regard ourselves as defenders of trade finance. Now, for the other 2 or 3 questions, I wanted to answer about Burma because it's at the heart of the development issue. Before, we have suffered, I mean, during the crisis, to an overexpansion of the financial sector in developed countries. That has, you know, been blowing there. And then by contagion, as you understood, by contagion, that has been hitting a low-risk segment of the financial industry, which have seen its prices or its availability restricted during a certain period. There was an international program to step in. The confidence was reestablished in this very liquid market, and things seems to be going right again. Anyway, financial markets are flooded with liquidity at the present moment. So if you want to clear a letter of credit from the US to Europe, it's going to cost you really a few basis points above LIBOR. Now, if you're going to try to get one in Burma, or in Myanmar, then the problem you will face is going to be very different. Here you are facing with an under-expansion of the financial sector. And why would we, as not a financial institution, care about it, right? And what we care about is the integration of the new generation of countries, right, into the global to the global trading system. And what we see is the lack of access to finance as a major non-tariff barrier to trade, and it acts as powerfully as a non-tariff barrier to trade than other, right? And if this one thing is not taken care of, because people since the financial crisis have a difficulty understanding that actually the finance does not flow everywhere. In fact, it is the opposite. It is trade, and I think it goes with the question on trade in task, because now international companies have become so granular in estimating the comparative advantage, which is the wage to productivity gap of different countries by task, because they know their markets. The financial sector is relatively unsophisticated in comparison to that locally. So it gets to the paradox whereby an activity can move, as you have now textile factory reopening, by the way, in Ethiopia, because industrial activity and textile activity, particularly in East Africa, has something of a history. So it's just coming back. You know, old trade routes being refilled by the Indian community and other investors. But then you realize that you have had some period of financial either underdevelopment or repression or whatever that makes the financial system actually very unable to drive this new globalization or to support this new globalization. And I think this is an issue we have to look at. It's complex. There's knowledge, know-how, and technical assistance and all of that. But I think one thing that is interesting for the trading community is that when you're looking at COMESA, for example, COMESA is now thinking in the way the European Union has been thinking in terms of regional integration with multimodal and priority routes of trade. Okay, we have the 8th corridor, for example, in the European Union, which go through the Danube, essentially, where we've been building highways, we've been connecting highways to ports, and so on and so forth. And COMESA is thinking the same way, to renovate ports in Kenya and then to rebuild the lost infrastructures. But what you see there, and then we had in the WTO seminar some of this reflection by the South Africans, is they've been saying that although we are now changing our mindsets in order to accommodate the new routes of trade, and certainly the routes of trade for Africa have changed a long way, and they will continue to change because it's about feeding the rest of the world and it's about providing other goods and commodities to the rest of the world. The financial infrastructure is stuck to the 19th century, or the way it was built in the early 20th century. And we realize how little sophisticated is that financial infrastructure. And it will take a little bit of thinking, at least to bring that information forward for those in the financial industry to think differently. 2 or 3 quick things. Growth of trade in services. Yes, when you start to actually do trade in value added, and then I direct you to the last paper of our working paper, the latest paper of our working paper series. Then when you factoring services in today's our calculation of global value chains trade, you see that there's a much higher share of services than in global gross flows of trade, right? But then I think that increases the perception of these global value chains. Why? Because the services are essentially provided in the north. So for example, when it's a north-south global value chain, then the value in services is provided in the north, and then it tells you that probably the trade in task on the industrial part, the most movable one, is likely to move according to that comparative advantage I was talking about. And the more services in a sense, the more mobility of the goods production around, and according to the comparative advantage. So what does this mean for trade finance? Not that much, except for what I've said, is that the more mobile is the capacity of large firms to go to new producers, you know, Sri Lanka or Bangladesh for bed sheets or whatever, the more it's going to put pressure on the local financial system to be ready. Some of them are ready, have done the reform in the financial system, some of them are not. So we're really talking about financial inclusion and financial sector development. And I shouldn't be doing financial sector development in the WTO, but I think we should have our eyes open as to what kind of things it means for the WTO. Industrialization of agriculture, yes. Here, the risk for the financier are much bigger than industrial, just shipping, you know, insuring or financing the movements of goods, you know, industrial goods, even, you know, for very sophisticated supply chains like X products that are moving around, you know, according to the little addition in value, but that's very easy to do, you know, with today's logistical platform. There, the banker takes ownership of the good, wants to make sure that it doesn't, for example, I'll give you one example, not very much known outside the community. You sell, when you sell commodity, a certain weight, right? When you buy coffee, right, or when you buy another thing, if the warehouse is poorly kept, you may lose out of 20% through evaporation of the goods if the warehouse is not properly maintained at the right temperature. The bank is responsible. So the bank has to engage local infrastructures and local surveyors, SGS and all others, that will take care of this. So the cost of production of that financing, that can be a competitive advantage in favor of banks, but the cost of financing of this is higher than just doing trade finance in manufacturers. And there is a know-how, and the banks keep saying that they need to be there. You just cannot turn around the trade finance world to generate capacity. It doesn't come like this. A kind of process like this, where you will be from point A to point B and make sure that the integrity of your commodity and the merchandise get to the final buyer, is something relatively complicated. And it needs know-how, and that's what maybe the banks have to sell. Now, that know-how takes indeed decades to build up. And now, there are current constraints that may make this kind of business less attractive, because, for example, you have new You are in the new world. You have new transparency rules for banks, which is good, by the way. The representative of the real economy will not go against more transparency in the financial world. But indeed, you need to do much more due diligence on the clients, on the clients of the clients, on the clients of the clients of the clients. And that has a cost. That has sometimes a reputational risk that you do not want to assume. And when I have been mentioning a number of transactions that some of the banks don't want to do anymore, it's because of that. Before, we had the gap between the perception of risk and the actual level of risk. We actually know now, since the trade finance repository, what is the actual level of risk, and we can guess from the market's prices what the perception of risk or the country risk. Sometimes the country risk and the company risk or the counterparty risk are completely in a sense, blurred. And but what is now the new gap is the reputational risk against the real level of the transaction risk. And again, here again, the flow of information would normally reduce that gap, but we are in a domain where we still are with practitioners, we still are with little statistics, we still are with surveys, and we are trying to work, at least from a public perspective, at just bringing in information so that the frictions in the transaction are less, both on the financial side and on the trade side. Sorry, I've been a bit long, but I think it goes in favor of it. Okay, good.
According to your watch, it's 6, so let's just thank the participants for organizing, promoting, and having a very nice and interesting session on trade finance. And for today, that's all. We'll see you tomorrow morning.
C'était vraiment super.